Hello, everyone, and welcome to another stream. So, Tuesday, markets kind of not doing much. It is August, so a period of low volatility is to be expected, except maybe on the yen. So you do have a prevailing story happening on the yen. So you had a massive drop, again, a massive appreciation of the yen, intervention, the pension funds. You have the Bank of Japan signaling rate hikes in the future. You have Scott Bessent, so the US doing a joint effort in pushing the yen to the upside. So there is some activity with the yen. Now, I also have Aussie dollar on the watch list. My plan was to buy the Aussie dollar going into the CPI print. The CPI print that is happening tomorrow at 14:30. Okay, so I was waiting for the RBA, for the cash rate statement press conference. That has happened, so that is now behind us, and we can see that the rate has been kept the same, but the forward guidance, the press conference was pretty hawkish. So if we look at, let's say, Aussie NZD, UD NZD, it is pushing up today. So Aussie catching a bid. If you look at the Aussie dollar, a little bit bullish on the day. If you scroll through Financial Juice, you'll find the hawkish statement. So let me show you. Let's see. So RBA, upside risks to inflation, bring inflation down, still need to see progress before being confident on the CPI, raise rates again if needed, okay? So kind of hawkish. I think they're concerned with the Middle East and the rising price of oil. This is good for my trade idea. This is good because I wanted to be bearish on the dollar, and the Aussie seems to be a strong currency at the moment. So the Aussie seems to be a pretty good candidate. Let's also take a look at the inflation. So what we're doing now is I'm trying to build a trade idea on being short on the dollar. So let's go to economic data, inflation, CPI. AUD. Let's take a look. So 3.8%, definitely elevated, kind of falling a bit, and falling from March, let's say, or from April. So that's kind of interesting, but still definitely elevated, way above 2%, and still a problem. So the central bank seems to be concerned with that. So that goes well with buying the Aussie dollar. Although what I have found today is the thesis for trading the CPI is no longer there, unfortunately. If you go to Polymarket, and we go to US inflation July, annual inflation, you can see that the sort of the chances have flipped. Now it is 42% chance of 3.4% and 32% chance for 3.3%. So my game plan was, or my expectation was to get a lower inflation than what it says in Forex Factory calendar. So it is an edge that you can trade. Basically, to make it super simple, you have analysts on Bloomberg and Reuters put out a forecast. You can find this forecast, I think it's this one on the Forex Factory. So the previous number, 3.5%, and the forecast from the analysts is 3.4%. But the thinking is, Polymarket is much more accurate because you have people putting real money on the line, and it's a lot of volume. It's a 500,000 in volume. So this should be more accurate than analysts. Now, when I looked at this yesterday, a 3.3% inflation was at 40%, 3.4% inflation was at 38%. Now it's flipped again. So now it is similar to what it says on Forex Factory calendar. So the edge is no longer as big. Now I can still do the trade, so basically buy the Aussie dollar before the CPI print, but I don't know, the edge has gone down. The edge has definitely gone down a bit. Let's try to see Kalshi. So Kalshi, US inflation, July 2026. Let's see what Kalshi says. So yeah, this should be it. So most people are around that it's going to be above 3.3%, but not above 3.4%. Okay, so Kalshi is interesting. Let's see what is the spread. The spread is actually fine. Can we find the volume here? If you're going to do this sort of an edge, always check the volume, because the volume will tell you if there is enough of a signal. But I'm not really seeing the volume here. If I'm being honest, I like Polymarkets much more. It's easier to read. Polymarket is easier to read. Yeah, I can't really see the volume here. Maybe I'm missing something. Anyway, Polymarket, the signal has been lost. So the edge has been lost a bit. I can still do the trade, but I'm not super keen on doing it. Maybe I can do it with small risk. So I'll have to think about that. One more development that we saw is Middle East. So we saw that Iran says that they will wait out the presidency of Trump, meaning they won't negotiate any longer with Trump. Trump kind of says a similar thing, that he wants reparations from Iran. So oil is up, but they can do another deal, or we can have another announcement of a potential deal this week or next week. So the situation is still super volatile. Trump is not to be trusted. Iran is not to be trusted. Very, very tough to get a read on what is actually happening behind closed doors. And I would say oil stays elevated for at least the end of 2026. So it stays inside of this range, and we're just gonna have to trade around that. So oil should go from, I don't know, from 90 to 100. I think that's kind of a realistic range that we can see. Let's take a look at the Hormuz traffic. Let's take a look. So August 2nd was the last update. Okay, we didn't get much, so not that important. Anyway, so Brent, I think it stays inside of this range. Should it be, or will it be a massive issue for the inflation? Well, inflation should go up a little bit. Inflation should be elevated even more in the future. But is it going to be a massive issue? I don't think so. And in the next 2 to 3 years, all of the countries in the Middle East, basically, they are going to try and build alternative routes. So pipelines, trains, trucks, by sea, by land, they're going to try and bypass the Strait of Hormuz. So that is how I'm seeing the situation, and we need to just trade around it. Personally, I think the next big edge is in trading the Fed watch tool. So in trading the Fed, let's take a look. So September is still priced in for a potential hike, 51.9% chance of a rate hike. I think the chance of this is basically zero. So I don't think a hike is going to happen. And that's a trade right there. Okay, that's a trade that you can execute right there, which means during the event or right after the event, you can sell dollars, you can go risk on, you can buy the Nasdaq, and that should be a good play to do. But that is on the 16th of September. That's more than a month in advance. So I also need to find something what I can trade in the meantime until the 16th of September. Yeah, basically the CPI could be a good opportunity. The CPI could be pretty volatile, could be a good opportunity. It could change also the odds for a September hike or pause. I'm going to have to think about that. If you're in the A1 Trading Discord, if you're a part of that, you will get notified if I take a position before the CPI. If you want to join the Discord. You can first join for free. I'll post the link right now to join for free. So let me go to Files, Links, Free Discord. Okay, you can find it in the comment section, or you can find it in the description as well. And if you want to become a paid member, get access to all of my positions, and it's also Nick, Chris Pulver, Iwind, Alan, so a bunch of really, really good traders. Well, you can use the code MARKUP to get 15% off. Now, this is for the A1 Trading Discord, the paid version, or for the Edge Finder. So if you want to get if you want to get access here or access to the Edge Finder, you can get 15% off with the code MARKUP. All of the details are in the description. All of the links are there as well, so do take a look. Or you can just Google A1 Trading Discord or Edge Finder, and you will find all of the information right there on Google. Okay? Let me just see. Yeah, basically. So I also have gold. I also know you want to see gold. So gold, big explosion up, massive, massive move. I'm looking to buy. It goes well with the bet of a weaker US dollar that I have. So buying gold is definitely something that I would like to do. Although currently the price does look a bit overextended. I think I would like to get in on a pullback, get in on a bit of a correction. The 200 EMA could work, like buying near 4,300. That would give me a bit of a better price, a bit of a better opportunity. So that would make sense, and we will see what happens. So gold, I'm really interested in looking for buy setups. Let me run it through the top setups as well. Let's take a look. Gold, very bullish, 8. That's pretty nice. But yeah, I need a pullback. And one thing that's important to note, let's say I do get in on a pullback. Tight stop loss. I'm not looking for a home run. So I'm not looking for a home run. I'm looking for 4,700 would be a good initial target, maybe 4,800, because I don't believe that gold goes to all-time highs. I don't think we'll have a massive bullish cycle like we had in 2025. If you do some backtesting, you will notice that gold has decades where it just does nothing. So here is the first example. From 2011 to 2019, nothing, bear market. And this looked pretty similar to 2025 here as well. This is your 2025, and then you have 20 years from the 80s to 2000s, 20 years of nothing. So I think that could happen, but you could get a relief rally. You could get a bit of a relief rally like you got here, or like you got here, for example. So this is basically what I'm waiting for, something like this. This is a relief rally. So this could be the start of that rally, right? We can hit, I don't know, maybe 4,800, let's say, let's be optimistic, and then we just go into a bear market, or we continue with the bear market. I also think you need retail participation for another massive bull run, which is probably not going to happen. Like the retail, they bought the top, they lost money, and they're not interested to go back in. They're not interested. So you need the retail to forget about their losses, and it usually takes a few years for them to forget about the bubble, about the money that they lost, and then they come back. Okay, so then they come back and they buy gold. Rate cuts not even on the table. Yeah, rate cuts are not going to happen. The Fed, like 90% chance, in my opinion, by watching the speech from Kevin Warsh, 90% chance that they just keep the rate the same this year. Just 350, 375. I think this should be at 90%. But that is great, because that means there's a lot of opportunities to trade this pricing because it's mispriced. I'm betting on a different pricing. I'm betting that this should be 90, 95%, and this should all be like This should be 0. This should be 0. This should be at 5% or 10%. That's kind of what I'm thinking for 2026. Also, if you look at the last time that the Fed initiated a hiking cycle, inflation was at 7%. So those guys, they usually wait for the absolute extremes in inflation to start a hiking cycle. When it's time to cut rates, they jump on the opportunity like this. But when it's time to hike, they pray and delay. Which basically means that they wait for extreme inflation prints before they actually start to hike. Sluggy says RBA got no chill. Inflation hasn't been bad. So yeah, looks like the RBA event was hawkish, which goes in my favor of looking for buy setups on AU. Now, inflation in Australia is 3.8. That's definitely elevated. Let's take a look at the last. Can we go 4 years? Yeah, okay. So this was after COVID, but the target inflation, I would say 2.4 is okay. 2.1 is even better. 3.8 is pretty bad. So I think a hawkish RBA does make sense. It does make sense. Now the question is, will they actually hike rates, or is it just a lot of talking like you have with the Fed, where it's just talk, no action? That's a different question. But at least until the next meeting, until the next RBA meeting, Aussie should catch a bid. Okay, the Aussie should catch a bid. So let me run through the comments. Good morning to everyone. Bull Expressor, not for a second I felt she would be turning dovish anytime soon. Anytime reporter asked her for rate cuts, she literally just shut it out. I didn't watch the conference, but I watched the financial juice, like newsprints, and it's pretty hawkish. AUD/USD longs, maybe. Yeah, that's what I'm thinking. Seems like the most appropriate. I mean, if Aussie does get a bid, can be longed against most currencies. Daniel says, hey Marco, I've just passed the 200k with FTMO, but they are stopping the 200k swing account, won't give me the account. What do you think about other props with the same rules as FTMO? Doing research, Ola Prime is a good option, but are they giving you different accounts, or are they not giving you an account at all? I would be super surprised if they did that. They should at least give you 200k accounts, right? So if you can just give us a bit more information. But Ola Prime is a good option, a good alternative, I would say. They don't have a consistency rule. They have pretty similar rules to FTMO, and A1 Live gets you 20% off. So Ola Prime, is swing trader friendly, and that is who we recommend. Put to call ratio for US oil. No reason not to trust Iran except US propaganda. Iran has always respected its understandings. What's your take on the Aussie? Bullish. Do South Africans also receive the 15% or 40% off? Yeah, it should be 15% for everyone. 40% is when we're having a summer sale or Black Friday or something like that. So it should be right now, it's 15% for everyone. Rate cuts not even on the table. Urban Picks, hello. The job market is doing good for Australia. Adore Bullock, she's a no BS governor, unlike others. Imagine saying that they don't give a F if growth suffers for some time. Well, for a good central banker, you have to ask yourself, compare the unemployment rate to inflation. The unemployment rate only impacts 4 to 5% of the population. So labor unemployment, let's go to Australia, AUD. So the unemployment only impacts 4.4% of the population, but the inflation impacts everyone, especially like the lower end and that's most people, lower income. Okay, so if you want to stay basically a good central banker and when you want to help the majority, you tame inflation. That is how it should be on paper. Now, then you have the Fed, who is perpetually dovish until things go absolutely nuts. But yeah, Bullock or whatever her surname is, she seems to be doing her job. Max, hello. Do gold. Can't wait to long GP CAD. Oh, let me just send the link to James. Okay. Let's see. Bank of England is always seemingly hawkish. They don't give an F. Euro pound versus USD. I'm a dollar prime and I like them, but don't like a couple of the rules. They won't give me 200K. I spoke to them this morning. They only give me a standard account or a refund. So you're talking about FTMO there. That sucks. That sucks. Well, take the standard account and try to trade around the rules. But I would say 200K accounts, I don't like them. I like the smaller ones. I like the 25K, 50K accounts because I can risk more. I can blow through a couple of them and then get a funded one and get payouts. So I don't really see the purpose of buying these huge accounts. I think a more efficient way, and I've did research with Google Gemini and ChatGPT, did simulations with my personal strategy and my personal performance. And the optimal account size for me is 25 to 50K. Because then I can risk maybe 1.5%, maybe 2% per position if I want to. With a 200K account, if I risk 2%, I'll lose the account and it's going to be a massive expense. So I like multiple smaller accounts, and you don't buy them all at once. You buy one, risk a bit more, let's say blow it, buy the next one, blow it, third one, get funded. So that's the name of the game. You will lose accounts. It's just the probabilities. But the key is that your payouts cover the failed challenge fees plus some more on top of that. It's good to long USD JPY at the current level. I personally wouldn't do that because I'm seeing a lot of yen bullish catalysts for the yen. So I'm expecting long term that this slides lower. But if you have sort of a short term trade idea, then you can go ahead and try. One thing that I know is previous times when you had a joint effort for an intervention, joint effort between Japan and the States, you had the initial crash, such as this one, and then the price completely retraced most of the move, and then the actual move started. So that has happened 2 times, I think one time in the 80s and one time in 2010s, something like that. I have the data on my email from Brent Donnelly. So we could retrace back to 164. It could happen, absolutely. But long term, I'm betting that the yen does continue gaining value. So I'm holding my Swiss yen short, holding 30% of it, and I'm going to see how it plays out. Prop firms are a bridge, not an end destination. Absolutely. The end destination or the main thing is your personal account. I won't be doing it again. I like FTMO, but I'm not happy with this, of course. I have our smaller accounts. Yeah, it sucks. It sucks. It sucks when a prop firm changes rules in the middle of you doing a challenge. So prop firms, they are not the main focus. They are there because you can get a lot of capital, but all of the payouts that you get should flow right into the personal. Or if you're really confident, you can go ahead and try and get more challenges. But I wouldn't want to waste thousands of dollars for prop firm challenges. I would rather try to build up a personal account, if I'm being honest. Like, yes, do prop firms on the side if you have an edge, but personal account, making a track record, that's the number one priority, because a good track record, and if you have, let's say you have 10K in your personal and you make a good track record, well, if you have 2-3 years of performance with a good return to drawdown ratio, now that is really important. So you can have crazy returns, but if you have a 40% drawdown, the returns don't matter. If you can have steady returns and a maximum drawdown of 10 to 15%, that's really, really good. And that enables you to attract investors and prove to people that, yes, I have an edge. Yes, I can actually extract profits on a large sample size. Totally unfair if they don't give you equivalent account from what you paid. You can try and leave a bad review. I know a tactic that some people had success with is if a prop firm changes rules or does something fishy, they go on Trustpilot, 1 star, complete explanation of what happened, and then usually the prop firm will reach out to you and say, how can we make this right? Let us try this, try that. So that could work. And then basically they tell you, let's make this right, and you remove the review. That's kind of how it works. I've never done it, but I have read about that tactic working. Okay, so I have 4 more minutes. The stock market is doing pretty well. Bitcoin is still doing nothing, so still super flat. And that is concerning. So Bitcoin looks very, very concerning. And the main reason is that stocks had a massive rally to all-time highs. Gold. So gold moved up as well. Big push up, big breakout out of the trend line. But crypto is flat. So crypto ain't doing nothing. That's an issue. That's a problem. So Bitcoin is showing relative weakness compared to other, let's say, not risk-on assets, but to other assets that react bullish when the Fed is dovish. So I think we are still in the crypto winter. I think we need to see a bigger correction, actually. 50K, 40K, I think that is much more likely than going to 80K. The halving cycle is currently in a bearish period until November. So the bullish period of the halving cycle starts in November. And I would say the healthiest option would be if corn goes to like 50K, 45K, and then in November it bounces. We probably wash away MicroStrategy here, so that thing blows up, which would be great to pure the space and so that we can start clean, right? So that we can start clean. I still need more lecturing on the Edge Finder. Well, there's a big guide that you can find on the A1 Trading channel. I know because I filmed it. It's like a 15, or I think it's 12 or 15 videos going into every single feature on the Edge Finder. So just go to YouTube, go to the A1 Trading channel, and you will find the tutorial there. Okay? Marco, October seems good for BTC bottoming, but I gotta give middle finger to all of the buyers. I think the healthiest thing would be if we just go to 50, 45, 40K and wash everyone out, MicroStrategy blows up, and then we reset and we can go back to maybe not all-time highs, but maybe 80K, some sort of a healthy level. Bitcoin right now is definitely super low priority to me. It just looks horrible. It's not reacting like stocks are going up and gold is going up. So it's not on my focus list. That is it for my first segment. Do not go anywhere because we have James coming on in like 30 seconds. Thank you for watching. You can catch me again in 2 hours. And yeah, I'll think about buying the Aussie dollar before the CPI print. It seems like the next best thing to do. So thank you and see you.
If you're looking to get funded and want to save big on prop firms, check out our website, A1Trading.com. On our website, we have a massive catalog of different sponsors and prop firms that are offering really competitive prices to our live stream viewers. On the screen right now, you see a QR code. If you scan that, it'll take you to this page that I'm looking at to scan all the different offers. You can also filter by one-step and two-step accounts. You can also look at futures, Forex and CFD prop firms, and even prop firms offering stocks. You can also select your preferred prop firm challenge size and check out our menu at the top for tons of different prop firm perks and giveaways. For example, every Monday we do a weekly prop firm giveaway that you can sign up and add your name into the hat for free. Additionally, we have prop firm reviews for notable firms, and we even have a side-by-side comparison tool where you can compare two firms head-to-head. Save big and find the right prop firm for you over on our website, www.a1trading.com. Thanks to our various sponsors who make this show possible. Now back to the content.
Hello. Happy Tuesday, ladies and gentlemen. Hope everyone's well. How is everyone? All having a good start to the week. So as always, I'm on for an hour today. So you stuck with me for a little while. And then we have Alan and then Nick. So we've got, well, standard schedule today, but a good lineup as always. So anyone buying gold? Yes and no. I am in gold, so I got in around 4,000, but I'm not buying it right now. 2288, good to see you, my friend. Jeremy, hello. Christoph, good to see you. Mr. Shakes, good stuff. Familiar faces here, which is good to see. So yeah, gold. We are seeing the market slow down a little bit today ahead of the CPI print we've got tomorrow, which is, pretty standard. I think the market's paying quite a lot of attention to that, or should end up paying quite a lot of attention to that. I don't really think it's going to be a huge deal, to be honest with you. And I'm not saying that in terms of I don't think the print is important. Obviously, it is. But what we've seen over the past week is the interest rate. Hold on, sorry, let me collect my thoughts. The interest rate hike narrative by the Fed getting completely priced out. Not 100% priced out, but depleting in terms of its probability. Now, obviously, again, that's happening ahead of the inflation print we're getting tomorrow. And it's largely due to the fact that obviously we're not getting good data. So one of the things, someone actually mentioned it in the chat yesterday, and it didn't even cross my mind, but it's 100% true, that we have had obviously poor labor data. We've got growth that's been slowing down here at 1.5%. The forecast was 2.1, and the previous was 2.1. So really bad growth data. Inflation has been coming down, but if we get higher inflation tomorrow, then the Fed's going to be in a little bit of a difficult position, because then we've got a weaker labor market, and then we'd have sticky inflation, or potentially even heating up inflation, depending on what the print is. So I would assume at the moment the Fed is hoping and praying and screaming for cooler inflation, because again, if that doesn't happen, we might find ourselves in a bit of a tough spot there. I'm saying we, I mean the Fed. I'm not involved there, thank God. So yeah, that's my current stance. I kind of do hope we get cooler inflation. Wouldn't be great for me, I would like actually a stronger dollar, but I think a stagflation environment would actually be a little bit worse long term for me to try and trade. So what we're talking about, yes, inflation. So I don't really have an expectation. The forecast seems to be that we are expecting cooler inflation on sort of general consensus, but personally, I don't care either way. Could come out hotter, could come out cooler. I don't know. It doesn't matter. However, I think we're not in for a huge print. I wouldn't expect us to be in for, anything significant above what we already are at. And the reason is because we obviously had inflation come out roughly in this period on the previous release. What was it? Was it 3.5? I can't remember what the exact number was at the moment off the top of my head. But either way, inflation cooled on the lower oil prices we had. Since then, we did have oil prices start to pick up. We saw also inflation expectations picking up as well, obviously on the back of that. However, oil hasn't really done much since the last print. So based on purely the oil input of inflation, it doesn't really give much. So the idea of having super hot inflation, I just don't really see it at the moment. However, what we do see is still elevated yields and climbing yields. So we do see the 10-year and 2-year US yields are again, climbing higher. So we're on a very clear upward trajectory and again, moving to the upside. So to put it really, really simply, the markets are kind of looking towards those rate hikes. So something to keep in mind, but again, we are seeing a little bit of the pricing out idea at the moment, at least until 2027. We do still have I think it's June next year. I think there's roughly an 88% probability of a hike either on June or before June. So again, we'll have to just wait and see. So it shall be fun. It shall be fun to see what the data is. Sluggy, hello. Jay, you say yes, small position. Do you mean on gold? Some moves happening now. On what, Max? Ray Beast, good to see you. Hey, Rat. King of Kings, good to see you. Okay. So my my portfolio is pretty boring at the moment. Nothing's changed at all. So I'm still short on the euro dollar. Nothing has changed here whatsoever. So I'm still in the short position, obviously. The setup hasn't modified at all, so I'm still happy to sit through it. The fundamentals aren't great. So we've been looking at this. Euro dollar is bullish on the edge find. I think it's got a score of 8 at the moment. So I'm definitely on the wrong side of the fundamental bias there. However, the technical side and the seasonality or historical side of euro dollar, I still really am in favor of lower prices towards parity at some point. This could completely not work. I'm fully willing to say that it's very much a trade where I'm basically in this trade expecting it to hit stop loss, but I'm still happy with the reasoning behind taking it, if that makes sense. So it's not like a position on, I don't know, like pound CAD, where it's like, I think it could work. I'm happy with it. The technicals are there, the fundamentals are there. It's a very standard trade. But yeah, euro dollar a little bit more on the speculative side, which I'm fine with. So we'll see how this goes. Dolly yen, sorry, still sat long on this. I'm not looking to really do anything with this trade. I'm happy to just let it go. And the reason is because it's obviously a carry trade. Nothing's changed. We've been talking about this repeatedly over the past 1 to 2 weeks. There's still a fantastic dynamic to basically just buy low. And again, one of the narratives I was harping on about last week, I think it was, or even the week before, was when we get the interventions, we come to 200. That's exactly what happened. So I started buying. And so far, that's been a very simple and profitable idea, actually. And gold. So gold is definitely interesting at the moment, because I know, was it yesterday or the day before, we had quite a lot of people saying they were buying and selling gold. There seemed to be quite a lot of activity on the retail side at this high. And I think it was basically due to 2 different factors. There was some people looking at this sort of resistance level. We had the high over here on the left, then it turned to support, and then it turned into resistance again. So there's people selling this, basically just trying to sell resistance, which again is fine. But then there was also people buying into it, following the trend on small time frames, but not unknowingly buying into quite a large resistance level. So I would suspect both sides are pretty underwater at the moment. And the reason for that is because, at the time, gold was hovering around this point. So people trading it on, the 15-minute, 5-minute, whatever it may be, will have been wiped out on this bullish move here. It's only small for us on the H4. But again, if you're scalping the 5-minute or the 15-minute, it's probably taking you out. And then the people that were, people that were buying here, maybe still in, barely. I don't really know. They might be okay, actually. But either way, I just don't think being involved in gold here is worth it. I just think it's far too much of a gamble to be involved. So, as I said, I am long at 4,000, and I've got another entry here at 4,050. So I'm just sitting in these long positions. But full disclosure, they are tiny, tiny positions. So, one of the things I was looking at was I kind of expected gold to go lower over the next couple of weeks to months. And that was basically on the back of the situation of the Strait of Hormuz, inflation, yields, so on and so on. However, that obviously hasn't happened. So luckily, I did get in. But again, they're tiny positions because I wanted to end up buying like a staggered position lower, like a DCA approach. So, half good, half bad. It's like, that's great. But again, the sizing really is a bit insignificant, to be honest. So what I'm looking to do on gold is actually get in on the next pullback. So ideally towards the 61.8, retrace into the previous highs. So, we've had the break, retracement, pull into the fib, retest highs, pull into the moving averages, and then continuation higher from that point. Whether that will happen or not, though, is, completely up in the air. So if we get hotter inflation, that could be a catalyst to drive this pullback. But then, you know, the question comes in, would it bounce at this point, or are we actually then in for either just continued range bound movement here, or even potentially back or beginning to break 4,000 and heading down to 3,500? We'll see. I think it really depends on how large the CPI print is, or how low it is. How high, low, whatever. You get what I'm trying to say. Depends on the impact of CPI in terms of what the actual data is compared to the consensus and forecast. So either way, well, not either way, actually, that's the wrong thing to say, but I am looking to be a buyer of gold as things stand right now. But again, that could change tomorrow, depending on what the data actually comes out as. Sorry, I'm a bit out of it today. I don't know. I feel half asleep. It's a bit weird. TYTA SAP. Titus SAP. I'm not really sure how to. Oh, ASAP, something. Whatever. Hello to you as well. On everything, James. Stock up, gold. Oh wait. Okay. Stocks up, gold's up. New Zealand, Aussie up. US dollar down. Risk on move. Yes, it does seem to be. Bro, I do Forex. How hard would it be to switch from Forex to options? I don't know. I'm not an options trader. Pakistan defense minister signals that US and Iran are close to an agreement. When was that headline though, Christoph? Because I just keep seeing negatives. I mean, again, that could have changed in the past hour or so. I've not checked in a couple of hours, but last time I did check this morning, it wasn't looking great, which is actually why we are seeing oil doing pretty well today so far. Excuse me. Although, actually, yes, Christoph, you are right. It does look like oil's not doing so well today, having looked at it again. So, yeah, I would assume something has come out, which was that Pakistan defense minister signals that US and Iran are close to an agreement. Okay, we'll see. I've heard the same thing many times, Christoph. We'll see if it actually follows through. What's up, James? GJ and GJ and GA is the short of the day. Short of the day, interesting. I'm not in this position, sadly, but I'll be honest, my friend. I kind of see it here. So fib from the I mean, technically speaking, this doesn't look too bad. Actually, you know, we've got the fib level, so we've come up to 61.8. We're touching the 200 on the H4. We've got previous resistance here. So yeah, technically it looks quite nice. We had an overbought RSI as well. So I think on a sort of reaction trade, maybe you could catch a little bit of downside. However, for me, I don't see the point. To be honest, I would be more than happy to just keep buying. So we've got pound yen that's reading bullish on the edge finder. The lower prices that we've seen on the intervention, I think, are just discounted to buy low. You know, as I said earlier, we've had no regime change. So we had the interventions, yes, but the interest rates are exactly what they were. We've had no change there. So the carry trade remains very, very attractive for traders and investors. So again, I think maybe, a shorter term short could absolutely make sense. But for me, it's not really ideal. Other than just the technicals, there's nothing here for me. Luna, good to see you. James, we've got GDP on Thursday. Yeah, we do. I'm not overly interested, to be honest. I'm taking a little bit of a break. So going away tomorrow. So you're not going to see me actually for the next 2 days. I think I'm here on Friday. But yeah, for the next 2 days, I'm going to be traveling, and then I'll be in a new location for a couple of weeks. So I'm kind of just taking a little bit of a chill on the markets. I'm getting a little bit burnt out. Anyway, what needs to happen to ignite the GBP CAD long positions? That's actually a good question, Christoph. Let's see. So I'm going to be honest, I've got no idea what's coming out for the Canadian dollar at the moment, or upcoming for the Canadian dollar. But as Sluggy said, we do have GDP for the pound coming out on Friday, was it? Thursday, sorry, not Friday. So fundamentally, it's still fine. There is nothing here that concerns me. Net positioning is not fantastic. The weekly change is good. Sentiment isn't good for sentiment isn't good for us. We are getting a bearish reading here. But as I always say, I don't really care too much about sentiment. It's kind of it's more just a secondary confirmation. Definitely not something I would base a trade off by any means. Economic growth here is bullish. Inflation data is bullish. So if we get the jobs market to flip bullish as well, that would obviously be another tick in the box. It would help jump this score up towards maybe 7 or 8, depending on exactly what comes out. Economic growth could potentially flip bullish, depending if the GDP comes out positive, but again, we'll have to see. So I think this trade is still valid, fundamentally speaking. I mean, the Edge Finder reflects that. However, on a technical side, it is looking a little bit ugly. So what I was doing here was a little bit aggressive for how I normally would trade. So what I was looking at is, hold on, let me zoom in here so you can see it. So we had the moving average cross here, just indicating that we've reestablished this bullish trend from this minor, sort of flip that we had, nothing overly serious, fib from the low to the high, and then pull back into the fib, and that's where we got long right here. So technically speaking, fundamentally completely fine. It looks great. However, the daily time frame looks a little bit even more better for us. So the second option here, and this is something else I was weighing up that I maybe should have waited on, but yeah, we'll see if it if it comes through. So we draw the fib from the daily low to the daily high, and we have the 38.2 fib level that lines up with the previous daily highs. Now, we have already rejected this level once before, which is why I didn't put that much weight on it and decided to go for this H4 entry instead. So again, we'll just have to see if this one plays out. It might not, that's trading, that's life. But yeah, as I said, technically speaking, the entry is fine. And actually, we are still holding this fib level and this previous high, or this minor high here on the H4. So I'm still okay with the trade, but obviously it doesn't have that much room left to continue lower without us getting stopped out. TPD. I'm not sure what TPD means. Oh, do you mean TP, as in take profited on gold long, held from 4,070. What's your thoughts with high calls on put ratio? Do you think the price could drop drastically? So in the current situation, Shakes, I wouldn't really go off the technical side. I think the best thing to do at the moment when it comes to really dollar pairs in general, so gold, euro dollar, pound dollar, so on and so on, primarily just focused on CPI tomorrow, because that is going to be sort of the next big thing, or it is the next big thing. So based on the put to call ratio, that could completely change based on whatever happens tomorrow. So I'm not really that interested, to be honest with you, in paying attention to what's actually going on now. Of course, we can look at trade ideas and things, but in terms of actually doing anything, I just don't really see the point. Pakistan news Pakistan news 10 minutes ago. Okay, Christoph, is that what you're talking about? The de-escalation headline. Do I trade for a living? Not really. Kind of, but not. I mean, yeah, yes and no. I don't think you will ever find someone who does trade full time. I think most people that do claim that on social media specifically are lying. Myself, Nick, and I'm sure almost every other trader you see that has some sort of social media presence, whether it be large or small, has something else. And that's not, that's not really a reflection on anything specific. It's just the fact that trading is a really volatile and uncertain job to have. It's very stressful. So I think realistically, the only way you could trade only, like no other income, just trading, I think you'd have to have tens of millions in a portfolio to do it comfortably with no worries and stress. And the reason I'm saying that is because, if you have a good trade, let's say 1 to 2, that could be tens of thousands, maybe even hundreds of thousands in return. So you're not going to stress too much about next month's bills. But if you're trading, 100K, 200K, even 500K, those types of losing months can still put you in a very, very stressful time. So I would never recommend trading full time. I always think you should have something else going on. Thoughts on euro pound? Interesting. I've not looked at euro pound in a while. I know that was a really hot topic for us at one point, and we just ended up scrapping the whole idea. I don't know what euro pound's fundamentals are actually at the moment. Let's see. I'm not even sure if it has it. Yeah, it doesn't really have anything going on. So you got a score of 1. So economic growth is bearish, jobs market's bearish, and inflation data and the trend or technicals are bullish. So Yeah, I mean, there is nothing I can take away from this. I mean, we're not even really seeing any score change. What, over the past, what, couple of weeks, maybe a week or two, we've not had any significant score, and it's just been sat in the middle ground. So there's no trend. It's not like we've gone from bullish and we're slowly flipping bearish or anything like that. We are just a sideways score. Technically speaking, it doesn't look too bad on the daily. We've established this bearish trend. We've created a lower high right here relative to the previous high. It looks all right. And this actually is a decent little fib pullback as well. So technically, it looks really good to be a short seller. And something else I always talk about when we do look at Euro Pound is sort of the behavior of this market. So because the UK and Europe are obviously very closely related and correlated, it's very similar to the Aussie New Zealand market. We often do see these mean reversions and essentially just kind of a large time frame range. So based on that idea, we've had the run up. It wouldn't surprise me if we end up continuing to run down back to the previous low here. Let's say 0.83, just again, for the ease of round numbers, because we have the same thing here. We have this longer term run to the upside, and then overall or longer term we have just continue lower. Same thing here, run to the upside, just continue lower after that. So that is really all I've got for Euro Pound. There's nothing else. I wouldn't take this because there's no fundamental backing there. But again, I think the technicals do look okay, but I don't trade technicals alone. So there's nothing for me there. Seasonality for GDP isn't good as we move towards the end of the year. Is it sluggy? I've never looked into the seasonality of GDP for the UK. It's an interesting point, though. I might have to take a peek. To be honest, though, it wouldn't surprise me if GDP just continues to drop in the UK. I don't really see anything that could influence GDP massively and when I say coming down, I don't necessarily mean in the next release. I mean sort of a longer term trend in GDP for the UK. So for example, the UK is really against any type of investment. If you're coming from, I don't know, let's say America, you've got no incentive to invest in the UK. You may as well just invest in American companies because the regulations are easier. The companies can grow quicker. Overall investment is easier. So for example, if you're in Silicon Valley, you can get investment very, very quickly. Within a couple of weeks to a couple of days, you can raise significant money, where in the UK or Europe in general, it's really difficult to raise any capital. So business-wise, it's not good. IPOs have completely fallen off a cliff. I mean, actually, they picked up recently, I think, but generally speaking, they're still very low relative to where they were previously. There's a massive cost of living crisis going on. There's all these there's all these fundamental issues going on that it just isn't putting money into the economy. So yeah, I'm really unoptimistic about GDP. Again, this is long term. I'm not talking about the next 1 or 2 releases. They could obviously fluctuate in between, but I think the overall trend in UK GDP is going to continue lower. Okay, Australian dollar Swiss longs. Let's see. Interesting. I don't think there's anything for this one either, to be honest. Let's just take a look. Is there a reading? No, there's not. So I'm just thinking here. So we do, I suppose, have a carry trade idea. We've obviously got higher rates with the RBA compared to what we do with the S&B. So we've got that aspect similar to sort of the dollar yen idea, where you essentially just buy it to benefit from the carry trade. So there is that, and we can kind of see that in this market where we are just continuing to sort of run to the upside here. But I wonder. Yeah, so actually it's similar to a lot of the other Swiss pairs we've been talking about, Sluggy. So if you've been watching my segments over the past probably 2 weeks, the Swiss pairs have been a big sort of topic because we had, I think, Pound Swiss, Euro Swiss, and a couple of other Swiss pairs getting readings. I think short term they were good buys, but what we are seeing is a little bit of a drop off. Actually, not necessarily Pound Swiss. This one's still quite strong. But either way, one thing that does really concern me with these Swiss pairs is the weekly time frame. So although on H4 and daily they might look really good to enter, so we've got the bullish trend, we're having these breaks and retests, it looks fantastic. But when we zoom out, what we can see is the sort of behavior this market displays, where we either don't make it to this 200 weekly moving average, or if we do, we completely reject it. You know, here we had a false breakout, come to the downside, another false breakout, and then we just have this rally to the downside. So I would really not want to be a buy and hold the Australian dollar Swiss. I think maybe a short-term buy with some type of alert, or, you know, a hard take profit. I wouldn't want to hold it beyond this 200 weekly moving average is what I'm trying to say. So I think the R&R here just isn't worth it. So excuse me. So yeah, I think, again, short term, yeah, pretty good, but it's just not really for me, I don't think, at the moment. Take some euro dollar. Euro dollar is a mixed bag for me, because I am in the short position, as I said earlier. However, I am willing to acknowledge I'm on the wrong side of this trade. You know, the fundamentals are bullish, but I've got my own reasons for being short outside of the fundamentals, because I'm not optimistic that we're going to see any real meaningful de-escalations in the Middle East. We can have these fluctuations in headlines like we saw not too long ago of oil, but generally speaking, I think it is going to keep on going. I think that will keep the dollar bolstered. I also am playing quite heavily on the seasonality of euro dollar at the moment, as well as the weekly sort of pattern we see on euro dollar here, where we come up to this trend line, we create lower highs, and then have a run down towards parity. Not always to parity, but within that sort of area. So that's what I'm looking for here. I'm looking for the continuation and repeat of history. So whether that happens or not, I don't know. But as I said earlier at the start of the stream, I've gone into this trade kind of just expecting to lose it. I'm willing to take the risks. I do like the idea, but the idea isn't grounded in fundamentals like my positions normally are. As I said, the fundamentals are actually bullish for the euro dollar on the edge finder here. So outside of my own idea that I've formed here, I would actually lean more towards the long side again, because that's where the fundamentals tell me to go, and that's where the 84 trend is to the upside here. So with that said, how would we look to get in here? So fib from the low to the high. So I think this actually looks quite good. I mean, the fib's a little bit misdrawn there, not a huge deal. But a pullback towards the 50% retracement would line up with the 200 moving average. It would retest this previous high on the left and maybe create a double bottom here, and then looking for this continuation to the upside. I think this is maybe the base case, but again, we'll have to see. I do think euro dollar is bearish, but I might have got the timing a little bit off. So seasonality on euro dollar, I think it was sort of the start to mid of September until the end of November, it's really bearish historically on 5, 10, and 15-year seasonality. So again, I'm happy to play on that a little bit here and use it as a bit of a confluence for my short idea. Euro pound's a frustrating pair. It is indeed. Euro pound's definitely not the most ideal. As I said, it's a very range-bound market, not in terms necessarily of like short term, but the general price action is really, really choppy. So if we go back to euro pound here, you can see it's just not very clean whatsoever. And even when we have these trends, they're not that great. You know, again, for the way I trade, I look for really measured pullbacks at 50% retracement, moving average alignment in terms of, you know, a very clear trend in there, and obviously the fundamentals on the edge finder. But in this case, this trend is disgusting. So, you know, we create these higher lows, but the moving average is still flip-flopping. These pullbacks are not 50% retracement, so actually more close to equal lows. And then when we do establish a bit more of a clean trend, we don't see, again, these 50% retracements. So this market just really isn't ideal for trend traders. Well, it is. You know, you obviously can trade it as a trend trader, but it's just not the easiest to actually execute. So yeah, I completely agree that it's a frustrating pair. What's the most optimal scenario where the fib golden zone comes together with a moving average? Christoph, I've got one example I can show you actually where the setup was kind of perfect. And this was the pound Aussie. I'm not sure if you were in my Discord at this point. You might have been, but we were short basically for a large portion of the downside we saw earlier in the year. So I can't remember exactly where the entry was, but I'm fairly sure we got in here. So I'm fairly sure this was the entry we took. It might have actually been back here, but either way, the setup's the same. So this is, oops, that's the wrong direction. This is kind of the quote unquote optimal setup. So we've got the 200 moving average that's above the 50. Obviously, if we're looking to be sellers, vice versa, if we're looking to be buyers. The previous high rejected off the 200 moving average, indicating that buyers couldn't maintain higher prices. Sellers stepped in. Just a little bit of a sentiment read on that one. And actually, in this case, we don't really have that much structure to the left. But in an ideal world, the fib zone here lines up with either previous support or previous resistance, and that validates sort of this break and retest idea into the fib, and then a continuation lower. And what we also saw in this case is the 50 moving average being used as dynamic resistance. So that's kind of the optimal entry, really. There isn't really much to it. Again, I tried to keep my technical approach really, really simple. But yeah, I don't. I've been trading for many years. I've tried many different strategies, and every single time the complex ones just fail. I'm not saying they don't work, but they failed for me. Whether it's just that I'm not intelligent enough for them or what, I don't know. But it's just too many things to pay attention to, too many things to line up. It's just too much. I'd rather keep it super simple, one zone, one entry, very clear stop loss placement, and then let the fundamentals and the trend do the job. So in this case, again, the trend is bearish. I've already got the direction. I don't need to do any work there. At the time, the edge finder was reading bearish, so I don't even need to do any research on the fundamentals because they were there. So again, super, super simple. Hello, everyone. Anyone else sell gold at 4,435 because of Elliott wave theory? No. I don't even know how to use Elliott waves, Mega. I think I'm not sure if ball out's here. I don't really see ball out that much in this stream anymore, but we did have a viewer. I'm sure he still pops in, but yeah, there was a guy called ball out in the chat. I'm fairly sure he traded waves, or does trade waves. But yeah, I don't really see it really as a common thing these days. I know Elliott waves and the ABC patterns and all that type of thing used to be quite big. I think in like the earlier 2000s. I wasn't trading back then, so I'm not 100% sure. But I think like the sort of older generation, the really technical people, I'm fairly sure waves are a big thing within their crowd. I think they really pioneered actually a lot of the technical stuff we see today, like the cup and handle patterns and stuff. I'm not saying they invented it, but I think they made it a lot more sort of mainstream for our generation, as we learn on YouTube or whatever it may be, internet in general. I think we learn a lot from them. Anyway, I know it's completely off the point. Gosby seems to be doing that too. H4 fib. Yeah, that's exactly it, Sluggy. I could have used gold, actually. That was a good point. I didn't think about that. So yeah, it's exactly the same as what we've got here. So in this case, fib from the high to the low. What we see is a 61.8 level actually here, lines up with the previous daily highs. The moving averages on the daily are bearish, but on the H4 here, we had the cross. So now it's a case, it's exactly what I just showed you. It's a case of waiting for this pullback into the fib zone, into the moving averages, and then continuation higher after retesting the previous highs as well. Anyone buying gold now? No, not for me. I think gold, and it's really difficult for me to do these streams right before we have something like CPI because, it would be very easy for me to sit here and say, I think gold's bullish, and I do think gold is bullish. I've got no reason not to think that. But then tomorrow, that idea could be completely scrapped. And then, people turn around and say, oh, James is an idiot for saying that. So, well, I can only do my best in the moment. So, yeah, well, I do stand bullish on gold. But, as I said, the technicals are there. Fundamentals are here on the edge finder. Gold is very bullish with a score of 8. I am very cautious. I wouldn't want to get involved in gold right now. As I said, I've got these positions down here. These are quite safe. These are quite low entries now relative to where price actually is. So even if we do get really hot CPI and the dollar does rally and gold ends up plummeting, at least I've got some time to actually react and get out of these positions if needed. But again, these positions are actually established for lower prices. So I put these positions on wanting and expecting to get in at 3,900, 3,800, so on and so on, every $100 down. So even if this does turn around on me, I can still add in more if needed. Again, as long as nothing has fundamentally changed like massively. ABC patterns have made me a lot of money. Very good, Mega. Ways for max gains, or it could be a wave 4 with a wave 5. I'm going to be honest, Meg, I've got no idea. I've got, really no idea what you're talking about. I get the concept, you kind of measure the moves, the pullbacks, and the runs to the upside or downside. I understand that, but I don't really know how they actually work, Gold swing traders. Yeah, you're in the right place if you're looking for swing traders. That's what we are, or most of us anyway. Hasn't confirmed. Fair enough. Yeah, I don't even know where are they? They here. So Elliott wave. Yeah, these are all Elliott waves then. So I'm not even going to try and decipher them here, but yeah, from what I understand, this is probably going to be really painful for anyone that does trade Elliott waves. But I understand you essentially do it like this. So you're measuring the highs, the lows, and then you're looking for like some sort of reaction off the 5 or the 4. You're looking for continuation, something along those lines. But again, I've got no idea, so don't take that as education. Please don't take that as James has just taught me Elliott waves. Do you understand the story? Oh, do you want to share the story on how you took over the elite traders from the previous people? I just bought it. Yeah, there's really not much of a story there. I was running a similar service at the time. I used to run a really small signal group. And yeah, somehow we ended up connecting on Instagram, and they were looking to sell. So I was, I'll take over. And became a minority shareholder in Elite Traders, and then eventually ended up taking over the whole thing. I trade lots of ways. Your way is good too, but the wave can scare you out of trades. Yeah, I think the reason I like the way I trade, and the reason I've not changed it for many years, I've made small incremental changes, but nothing that's really changed anything significantly. It's just because it's so simple and it's so reliable. So as I've said this many times before, but if you don't trade the Fibonacci, I'm not telling you to trade it, but if you are someone that is very, very skeptical on it, which I understand, just go and have a look, because you can essentially draw it. I mean, obviously nothing ever works 100% of the time, but if you draw it in a lot of these moves, in the trending market, you take it from the high to the low, or the high, take it from the high to the low, or the low to the high. You will often find that a lot of the pullbacks you could essentially get in on are measured by the fib, and it's not something that is a reactionary tool, because you can measure it before the pullback has sort of finished, if that makes sense. So like here, it's not a case of the move's already happened and then I draw a fib. It's a case of, okay, we've created this bullish leg. This is the current high, and that's where I draw the fib to. So now I'm just waiting for this pullback here. If we get the pullback, I can react to that. Whereas, a lot of sort of technical analysis relies on a little bit of hindsight. You wait for something to happen and then you get in. Whereas here, I'm already anticipating the entry, if that makes sense. Again, a super simplified explanation of that, but hopefully you get what I'm saying. Advice how to switch swing trading from scalping. Scalping has destroyed my trading in psychology. I think a lot of people can relate to that. Okay, so the first thing you need to do is forget everything about scalping. Scalping strategies don't typically work on higher time frames, and the reason is because the markets are essentially driven completely differently. So, and that, bear with me with that explanation. So what I mean, when you're trading a 1 minute time frame, for example, or even a 5 minute time frame, the markets are not really driven by the fundamental drivers. So you're reacting very, very quickly to very volatile, very quick price action, such as session opens. They can be essentially completely random. You've got no real guidance on which way the session is going to open, whether it's bullish, bearish, or by how much. So forget, again, if you want to switch swing trading, forget that. So with swing trading, the reason I love it is because it's just so chill. You like this. I've been watching this entry for like a week, maybe a bit longer, maybe even 2 weeks at this point. I don't really know the exact time, but I've been waiting for a long, long time for this trade. And it's still nowhere near my entry, which is fine. But my point really is that like I said, with scalping, you're reacting very, very quickly. With these trades, you're relying really on the overall daily, H4, weekly trends, whatever time frame you choose. You're relying on those trends, and those trends are driven by actual factors. It's not a case of, the session's opened, it's bullish, or we just had a headline come out and now it's moved it's just taken me out 3 times. Obviously that can happen, but not generally speaking if you're trading like the daily time frame, for example. So I think I said it yesterday, when you're trading with the trend, you're by default, again, generally speaking, by default, trading with the institutions, because they're the ones moving these markets. They're the ones making these trends and pushing the market in a certain direction. So it makes it so much easier already. And you've not even done any work. You've slapped on a moving average, you found the direction. And as long as you can figure out how to actually get in on that direction and validate the idea, it's simple. And you can essentially sit there for as long as you want to sit there. Obviously, as long as the trade doesn't break. So my advice, if you are, again, wanting to switch from scalping to swing trading, is follow trends and keep it simple. Again, with scalping, I've seen a lot of people, they'll have lines and annotations and boxes and stuff everywhere. I know this looks a bit messy, but in reality, it's the fib and 2 levels of resistance. That's all I've got drawn up. But yeah, I've seen scalpers make their charts so complicated. You don't need to do that, really, especially with swing trading. You don't need to decipher individual candles. You just need to identify a trend. Okay. But when you swing trade, have you captured mega moves? Yes, fibs are good and are part of Elliott wave theory. Interesting. Yeah, I can understand that. Again, I don't know much about them, but from what I do understand, it's a similar concept in terms of trying to catch the pullbacks and continuations. So yeah, I agree. Do it on a separate account, keep it strictly limited to them, then collect data. Yeah, that is actually a good point. So like, I didn't even mention sort of the back testing side of things, but yeah, obviously you find a strategies first of all. And what I've explained in the stream, it's probably one of the most simple approaches you can have. Of course, I mix it with a lot of like central bank forward guidance and fundamentals, but in terms of just a technical start, it's fine. Just slap on 2 moving averages of 250, look for the 50% retracements or the 61.8 within this sort of zone here is fine. That's what I look for. Make sure you're in the same direction as the trend. Make sure the fib lines up with previous structure on the left like it does here. You're good to go. Maybe we broke above 4,370 and now retesting its support. Not a bad area to try and long here. I would disagree with that. I understand the idea, but looking here from an H4 or on the H4, this looks a little bit like you're buying the high, which can work. You can buy high and sell even higher. I'm not saying I'm not saying it's not going to work, but I don't really see this as a great buying opportunity. I'd rather wait for a bit more of a major pullback here, which I do think is likely just based on the technicals. But I could be wrong. We could end up coming even higher and creating a new high up here and then pulling back to this level. So we'll see. They can work, but from someone that does a bit of both, I can tell you, if you learn, don't learn that. I'm not sure what that means, Max, but I think I agree with your sentiment, I think. Is it safe to say that most swing traders start in low timeframes? I don't know. I would assume so. And the reason I'm saying that is because a lot of trading education is about sort of day trading and scalping. If you go on YouTube and search up how to start trading or Forex trading or something, a lot of the videos are just like SMC, 1 minute scalping and that type of thing. And that's just that's just by default where people end up going to, just because there's so much content of it. It's got so many views. So I think that kind of forces people into scalping without them really realizing it. And then, they have these troubles where it's so difficult to do realistically. They end up going to higher timeframes because it is just easier, in my opinion. I trade VWAPs and I do scalp NQ and ES now and again. I've slowed down on it, but I do still do it. And honestly, it is really stressful. There's days where it's phenomenal. You just catch a huge move on a 1 minute time frame and it's great. But then you can very easily go into a five losing streak. But that can happen within half an hour. You can very easily lose a lot of money very, very quickly. Whereas with swing trading, that can't really happen. Obviously, if you've got loads of positions on, obviously that can happen. But if you're taking it seriously and you're managing your exposure and your limits, then it could take, you know, a couple of days, couple of weeks to really have any meaningful losses or drawdowns. And by that time, the time span between it allows you to come to terms with it, relax, and, you know, freshen up whilst it's still happening, if that makes sense. I started as a swing trader, tried day trading, and very quickly moved back to swing trading. Oh, Luke, don't blame me. This is financial advice. No, I'm joking. It's not financial advice. But seriously, if you are new to trading, you're still trying to find your groove, my only piece of advice or suggestion to you is do not day trade. You can scalp, you can swing trade, do not day trade. And the reason is because it statistically is the worst way to trade. I think there was a study done, and I can't remember what the exact data is, but there was a study done, I think it was across like 20,000 day traders or 2,000 day traders or something. It was a decent sample size, I think. I think they were studied over the course of either 1 year or 2 years. I'm fairly sure it was like 98% of them lost money. And these weren't just like regular people. These were like people that actually tried to take it seriously. So it's very, very difficult. Whereas on the 1 minute time frame, yes, it's very difficult, but I think there is some opportunities if you can try and carve out an edge. And then with swing trading, I would say that's absolutely the easiest, because again, you are just following the wave. You don't need to do anything. You can just sit back, chill, find the trend and buy into it or sell into it. Obviously with fundamental confluence, so on and so on, but you get what I'm saying. Death cross and golden cross is good. It is, Mega. Yes, I love to see daily moving averages cross. I see most YouTubers scalp on stream. Watching and doing it very addictive. Yeah, that's the thing. It's the dopamine. It's the same as gambling. It really is. It's like it triggers all the same brain chemicals and outputs. Really, you know, you're risking money to make money. There is no difference. Again, that's specifically with scalping and retail scalping. With, again, swing trading, that type of thing, you kind of do need to do a bit more research. So I would say that's a bit more of an educated. I still say trading is gambling. I do agree with that statement, but I think there are levels to it. You know, you can have professional poker players. Doesn't mean that they're necessarily gambling, but they are technically gambling. Do you see what I'm saying? But it's educated. They're doing their best on informed decisions. It's not a case of spinning a roulette table. And I would say that's equivalent to trading. It's like we are risking money to make money. There is no certain outcome, so it is a gamble. But we're putting the money on because we've got some sort of informed decision that we do have a reason to think it's going to work out. But yeah, again, with scalping streams on YouTube and stuff, I would say it just triggers your dopamine and things and does exactly what gambling does. What's the difference between scalping and day trading? Scalping is sort of 1 minute. Oh, by the way, I like your Karomi picture. Scalping is like 1 minute, 5 minute trading. Day trading is more sort of like the 5, 15, 30 minute timeframes. So with scalping, you can take advantage of inefficiencies in the market. So, you know, if you're trading NQ and something happens at a 1 minute time frame, you can react to that. You know, again, sort of in theory, you can react to that and make some money off it. But on a sort of 15-minute time frame, you're kind of trapped in between both. You're trapped inside the intraday noise on like the 1 and 5 minute time frame, but you're not high enough to benefit from the higher time frame trends. And that's my opinion. Again, there's no factual scientific paper to back this up, but this is just from my experience. I just find day trading is actually, I suppose there is data to back it up. Actually, it's the one I just referenced, but yeah, I just think day trading is the worst way to go. Again, I'm not saying no one can make money. Of course, anyone can do anything, but statistically speaking, it's really against you. I know I've been yapping for a long time, by the way. I will get back to the charts if anyone has a request. When you day trade or scalp, you are trading in random. Yeah, that's exactly it, Ray. Yeah, a lot of the sort of intraday noise a lot of the intraday movements is just noise. For example, on like euro dollar, for example, you can trade a 1 minute time frame in theory, but you know, the moves quite often aren't directional moves or speculative moves. You can get trapped in things like corporate transactions. So, you know, for example, if I don't know, yeah, let's say Apple wants to transfer or exchange dollars for euros. Obviously, it's Apple. It's going to be a lot of money. It's not going to be, you know, you're not even going to notice it on a 15-minute time frame or a 4-hour time frame. But on a 1 minute time frame, you might see a bit of a spike. Potential. I'm not saying absolute, but there is that potential there. So it's noise that you cannot account for and cannot trade because it's just noise and it's random. I once tried scalping, had an anxiety attack. Oh dear. Don't quants day trading. I think quants really are just scalpers. And actually a lot of quant isn't necessarily just what you think it is. A quant trader, you know, if you take Jane Street, you know, they are a quant firm. They're not buying and selling like what we do. It's not a case of they're sat there with an algo on the side, like a MetaTrader EA trying to scalp a 1 minute time frame. They do market making. So they are quants and they are trading, but it's just complete. It's a different world to what you and I do and what most people do actually. So yes, quants trade, but it's just different really. Future prop firms don't allow swing trading. Yeah, I know. I'm fairly sure FTMO got rid of their swing trading accounts as well. And I think there is a reason for that. And I think it's because swing trading is actually what works the best. Most people are making money on the accounts and they don't like that. They're fiber optic cables. Well, I've got fiber optic cable, but I think Ray, I think you're referring to the ones that was how much was it, like 3 billion, 30 million, 300 million? It was a lot of money. I can't remember the number. A lot of money. And I think they got like an extra 2 milliseconds of speed or something ridiculous like that. But yeah, they spent a whole load of money just for an extra, not even a second of speed advantage. But yeah, you are right. Yeah, they have speed that we can't even comprehend or have access to. I see tops and bottoms within 1 minute. Okay, right. We've been yapping for about half an hour, so we should probably get back to the charts. Because I would like to come back to the stream. I don't want to get kicked off if it's just sitting here and talking. So yeah, my positions are meh. You know, I'm doing okay. You know, euro dollar's in a little bit of drawdown, nothing significant. Dollar yen is doing very well. Gold, my positions down here are doing well in terms of price movement, value, not that much. As I said, they're small trades. Pound CAD is looking a little bit bleak, unfortunately. So yeah, that's the current situation. Pound dollar might be interesting to look to buy at some point. Again, we do have CPI coming out tomorrow, so I wouldn't personally be getting involved today. I wouldn't be placing any new trades. But depending, again, on what the data is, there might be an idea of being a buyer at some point. So again, it's difficult for me to try and find an entry because it could get completely wiped out tomorrow. But I would be looking for some sort of pullback within, you know, maybe to the 200 moving average, something along those lines for this continuation to the upside, break out of this downtrend that we've been in, create a new high, and then maybe on the next lower high, on the higher low pullback, maybe into these previous highs retest, then maybe I could actually look for a long position. So there is absolutely potential in pound dollar, but right now I think it's just a little bit of a bad time to be involved. Pound Swiss, really frustrating here actually, because I was looking to be a buyer at the daily highs. So, you know, we've got the highs on the left. We've had this breakout. I was looking for the retest into the fib zone, into the 200 moving average, and again, retesting these highs. And then expect this continuation. We've not had that though. We are still sort of just sideways after 1 or 2 weeks of just nothing. So it's not great. And then again, this weekly time frame is a little bit of a concern for me. As I said earlier, with the Australian dollar Swiss market, the weekly time frames on these Swiss pairs are just really not ideal for buyers to just hold. So I think the opportunity in terms of the weekly time frame is getting smaller and smaller. So obviously, the longer this market ranges for, the lower this 200 is going to get, and that reduces the R&R significantly. So day by day, I'm getting less and less interest in pound Swiss, but we will just see. Euro Swiss I've scrapped. I've actually got no interest in this one, so I'm going to remove that. US 30 does still look really good. Again, same type of entry. You've got the bullish moving averages or the bullish trend. The fib lines up with the previous highs. Both actually are decent. So this high on the 50% or this high sort of still within the fib zone towards the 61.8. So yeah, some sort of pullback here would be fantastic. So I think US 30 is, again, just very much a wait and see market. The FTSE is very similar to the pound Swiss in terms of it's just range bound. There's nothing going on here, but the setup looks okay. Bullish trend on the daily here. The 50% retracement lines up with the previous high. So again, pullback, retest into the fib, continuation higher. Aussie New Zealand. We were looking to be sellers. However, I scrapped the idea because I actually saw the fundamentals as too weak and I just don't really like it. So I'm actually looking more towards maybe being a buyer next week. I'm not going to do that today or this week. But I want to just see this market do something. So we are still in a downtrend, but the fundamentals don't really warrant it. The Australian dollar on COT data is more favored than the New Zealand dollar at the moment. So yeah, I've got no interest actually in being short. So again, I'm just going to wait for some sort of development really to maybe get me into a long position next week and see how the data goes. And then dollar Swiss, we were discussing yesterday, and I was saying the technicals looked okay, but it just wasn't great. We did have it bearish on the edge finder, but the makeup of the bearish reading wasn't really worth it. You know, we didn't have that much in terms of the fundamentals there. It was mainly I think it was retail sentiment and the technical signal that was heavily driving the bearish reading. So again, that's not really something I like. I like the fundamentals to be there. And on the technical side, we did have this fib zone, you know, from the high to the low, and we had previous structure on the left. But the price action here just is too choppy. We've not created a new low. The moving averages are a bit too sideways here. I just don't like this trade. There's just a bit too much noise. And again, the fundamentals aren't there either. So I'm going to scrap this one and completely get rid of it. But yeah, that kind of wraps up all my topics for today. Darrow06X, hello to you as well, my friend. Hope you're well. FTMO. Oh, we're talking about the swing. Yeah, FTMO did get rid of their swing accounts. What do you think happens if the Fed help to Japan doesn't work? US dollar yen makes new highs. Yeah, I mean it's not worked. So the thing is mega danger. They can intervene all they want. You know, they could intervene even more right now. It doesn't change anything. There would very likely be sort of concern selling, uncertainty on selling, but I think overall it would still get bought right back up. So the problem they've got, and I spoke about this yesterday. I'm not gonna do a full segment on the yen at the moment, or the Bank of Japan don't have time. But the problem is the yen pairs, specifically dollar yen, pound yen, euro yen, they're great carry trade markets. You get paid to just buy and hold. You don't need to do anything. You get paid swaps, and obviously the trend is very bullish, so it's great. So until the BOJ hikes rates and the gap between the Federal Reserve interest rate and the Bank of Japan's interest rate starts to narrow and that carry trade dynamic starts to get depleted, this market will continue to run higher, regardless of how many interventions they do. So you can see that every time, you know, how many times the BOJ intervened over this period. I'm actually not sure. I don't have the data for that off the top of my head anyway. But you can see it here. You know, intervention. I don't know if this was another intervention or what, but maybe it was. Either way, it doesn't matter. You can see the point. Every time it gets brought back up. And again, the reason is because the carry trade is still there. There's been no policy change. The regime of this market is still the same. So yeah, I personally don't mind continuing to buy dollar yen while it's on a discount. Gold movement for the next few days. I could not tell you that with CPI coming tomorrow. It could go higher, it could go lower. I really don't know. Currently in a buy position on GU. So GU, I would say, is bullish. The problem is, I would say right now it's probably just due for a little bit of a pullback, you know, reaching these previous highs on the left. So I wouldn't be optimistic on it running higher right now. However, we do have the edge finder that's bullish. It's the most bullish reading with a score of 11. The bias is very bullish. So I would say, yes, pound dollar is a good buy on the fundamental side. The technicals to me look a little bit rough. We do have a bullish trend here with the moving averages, but we do also have these consistent lower highs that keep getting printed. So this might be the break. You know, we might end up breaking this little bit of a trend and continuing higher from here, but yeah, we'll have to just wait and see. I think, again, for these dollar pairs, the big thing is tomorrow with CPI. I think that's really all we can do as traders right now is just wait. Right, I've got 1 minute left, so let's try and wrap this up. James, what is CAD strength we are seeing? It's just mean reversion. I'm actually not sure on the data. I'm fairly sure the Canadian dollar was doing quite well actually on the heat map, but yeah, I'm not 100% sure. I don't have time right now to go and reference a calendar. Like I said, I've got a minute left. But yeah, the Canadian dollar fundamentally is doing quite well. Obviously, the Canadian dollar is tied to oil. So how's oil doing? Oil is down, which would be a drag on the Canadian dollar. Yeah, we're not really seeing too much, I would say, here. A little bit of weakness with the Canadian dollar, Aussie CAD. I think, to be honest, regarding the CAD strength, it depends which market you're looking at. Hi, bro. Hello to you as well. I'm not going to read that name. I can't. It's too long for me. A bit dyslexic. 3176. Good afternoon. Scalping is trading inefficiencies and liquidity with some sort of, yeah, I agree, Sluggy. I think fair value also comes into it. I trade, like I said, the VWAPs, and that does work quite well. So I think in terms of trying to find value and that type of thing on low time frames is quite useful. Oh, they still have swing accounts. Interesting. I was told they got removed. And sometimes I see you guys, experienced traders, say a lot of fancy words. Where do I learn the basics from? These aren't fancy words. I know it might sound like fancy words, but they're not fancy. The only reason they might sound like that is because they're not common words used within the English language in day-to-day life. But like intervention or policy or regime, those types of things, they're just sort of finance words for very basic terms. So what I would do is watch the A1 content. They've got a lot of sort of courses on fundamentals. Watch my content, watch Trader Nick's content, and the other guys in the A1 stream. Pick up what you can, what you don't know, write down, and either chat GPT it, Google it, research into it. Because again, a lot of the things I talk about are really, really surface level in terms of fundamentals. I'm not an economist, I'm not an analyst, I'm a trader, but I do account for the fundamentals as best as I can. So trust me, you'll be fine. I'm definitely not the sharpest nail in the bunch or whatever the saying is. I mean, I can't even get the saying right. There you go. But yeah, I managed to do it. You can as well. Trust me. Guys, that's the end of my stream. Alan Perez is coming to take over. The one and only handsome fella. Guys, stay safe. I won't see you tomorrow or Thursday, as I said. So I'll see you on Friday, I think. Guys, stay safe. I'll see you very soon. Enjoy CPI and don't blow your accounts. And don't get margin called. Have a good one.
Don't go anywhere, traders. We'll be right back to the show. But real quick, I wanted to tell you about today's live stream sponsor, Prop Shop Trader. If you're a futures or equities trader, let's talk a little bit about what Prop Shop Trader has to offer. So first and foremost, if you're a stock trader, there's not a lot of firms out there offering stocks. So this creates a unique opportunity for stock traders to get in on the prop firm action. Prop Shop Trader offers a variety of various different account types for both swing and day traders looking to trade futures, whether that be gold or Nasdaq or ES or YM, whatever you trade there, or on the equities side. They also have a very scalable environment where you can actually trade up to 20 accounts within the same prop firm. A lot of traders nowadays are trading with lots of different prop firms, but Prop Shop Trader wants to make it more accessible and stackable to build your relationship with a single prop. With competitive pricing and transparent rules, Prop Shop Trader stands out as a solid option to consider for those of you who are trading futures or equities. If you're interested in exploring Prop Shop Trader for yourself to see if the accounts are a good fit for your trading style, then make sure to use our promo code A1 Trading to get a really substantial discount at checkout. Our code will get you the best available prices right now. As always, I want to disclaim that prop firms are a great way to scale up your trading capital if you have the skills. So I am personally a fan of waiting until you have consistency in your trading before attempting to take any sort of prop firm challenge. But if after reviewing Prop Shop Trader, you like what you see, it fits your style, and you've done your due diligence on the prop firm, you want to push forward with it, then make sure to get that extra discount with our promo code. You can also find the link for this down below in the description. The live stream chat should also be seeing that pop up, and we have a QR code on the screen that you can scan to check them out now. Thank you again to Prop Shop Trader for sponsoring today's live stream. Now back to the show.
Good morning, guys. Welcome back to another one of my segments here. Thanks to James for that awesome one. He goes for an hour, which is fantastic because he deep dives into all sorts of concepts. Obviously, we have quite the crew here at A1 behind the scenes on this show, and I enjoy listening to all of them myself. With that said, let's talk a little bit about the runway to CPI. Today is yesterday was kind of a sleepy day in markets. I don't know if you guys, maybe not if you were watching gold. Gold made some movements, but if you were watching stocks, for example, real tired, real sleepy here, not making any sort of massive movements in terms of S&P 500. I am generally more on the positive side of stocks. I own several individual companies, although I did take some profits on some stuff yesterday, like on just like my portfolio. Let me take that back. I took some losses and some profits. I just closed out of some stuff. Yeah, no worries, James. That was a last second switch on our side. I've got some electricians coming to do some work at my house, so I had to swap the spot with Alan today. So I am surprisingly earlier than usual. So yeah, real sleepy start to the week, but that does not mean that the second half will be quiet, because with both CPI and PPI, there is a lot of inflation data that is sort of pent up right now that could really get things moving. I think the spot right now, I have to say, the only thing that like really sticks out to me as an obvious trade, the obvious spot to be, is gold. Gold longs make a sense to me. I am bullish on gold on retracements. The challenge, the trick is waiting for that pullback, right? There's not a lot here that I can do because we've not had much of a pullback. It's been a phenomenal run so far. Congrats to everyone who is bullish. And Mike's fixed. So here's the thing. I changed absolutely nothing. It's definitely some kind of software thing. Like the streaming software I'm in must have done something on my computer. Maybe I restarted. Well, I did restart my computer. It probably was that. Like there's probably just some setting. Who knows? But hey, doesn't matter because we are here. It works. And that's all good. So yes, silver's pulling back a little sharper than gold here today. If I drop down to 4-hour charts, let's get into some, kind of possible setups. I do like silver. I also like gold. Both of these would be possible prospects for long side entries. Maybe a more aggressive approach on silver would be this 50% retracement. Though I have to say the trade that I like, the trade that I really want, is that 61.8% retracement. Which, granted, it could come back swinging real quick. Like the thing is, you can get some really, really fast pullbacks on precious metals. Like they can look like they're never going to have a pullback, and then all of a sudden they're down sharply, right? So when I look at gold, when I look at silver, there's nothing that I can do here from I really want to be long gold. Like this is not my entry, right? That's not the trade that I like to take. I'm not saying it's not going to go higher. It certainly could keep moving higher. But if I'm looking at gold and I get my handy dandy Fibonacci retracements out and I say, okay, where do I see some solid confluence on price action? Where do I see a logical setup? There's really two spots that make the most sense here to me. And that is going to be the 50% and 61.8% retracement zone. So if price were to come down, then that would give me kind of that opportunity at which I think, okay, now I have a good risk reward setup. Because if you get a couple days down, maybe 3 to 5 days of sort of sideways to lower price action, which maybe that comes from CPI, then I start looking at this and I think, okay, this is a risk reward that I think is real sweet, because I know where I kind of want to put my stop loss. I would want to put my stop loss, generally speaking, below this 61.8%. So these are like levels that I could be kind of mapping out here. We've got this area of 41.50, 41.45. So I'd probably want to put my stop loss below there. That's where I'd say, okay, this momentum here that we've got, I generally want to see it holding. Like I don't want to see this thing, doing this guy, right? So for me, the best risk reward trade, the trade that gets me to take the position, is a pullback likely into these key zones. So that's pretty much it. That with gold, gold is the most obvious trade in my opinion right now for my personal strategy. When I say obvious, I'm not saying it's the most obviously going to make every single one of us money. Like I'm not saying that at all. Trading, I listen to I'm sure many of you guys are familiar with Larry Williams, but I was listening to him speak on a program yesterday. Very fascinating, like his takes on trend following and his concepts of small risk per trade and waiting for the big one. And I was like, you know what, this is so exactly spot on with generally speaking how I approach markets too. Obviously everyone has their unique styles, things they like to trade, etc. But for me personally, a big aspect of my trading is so much of it is waiting, right? So much of it is waiting for a pullback, but also when I'm in the trade, like let's just daydream and pretend that we're Alan Perez, who is already long gold. And let's just say that for whatever reason I'm long and I'm holding on to this. There's a tremendous amount of patience that goes into catching the runner. Like to me, trading is simple, but it's not easy for one big, huge reason. And that is, in my personal experience in markets, what has been by far the most successful and the most frustrating is waiting for stupidly large winners. Okay. So I'm talking about you get long gold. This is the greatest trade of my career by far. I don't know if you guys were watching me at that time. A lot of you probably were. Some of you probably were not. I got this long trade on gold, and I'm going to brag for a second because it was like the greatest trade I've ever experienced in my entire life. Unfreaking believable. I'm not joking when I say this. I'm trying to prove a point here, and I promise this was not an easy every single week type of trade for me. I was up $160,000 on this trade on one account, and I had it in multiple. This was the stupidest move that just did not stop. By the way, I'm still riding the coattails of that trade. Do you guys realize, like, most of my profits for the entire year, half of my profits, if not maybe more than half, were from that one trade? One trade. Now, that's not for everybody, but let me tell you what's not for me. I'm not a base hit trader. I'm not a base hit trader. Now, I have some strategies that help to even out my trend following. But trend following is like everyone wants to be a trend follower in their mind. They're like, oh yeah, I want to be a trend follower. I want to trade with the trend. I don't think you actually do. Some people do, but most people do not. Let me explain. Trend following means that when the thing goes in your favor, you don't touch it. It means you sit there and you wait and you wait and you wait and you inevitably give back a chunk of that profit. Let me explain. When I went long gold and this thing was the stupidest, I mean, I say that like it was awesome, but it was just like dumb how every single day gold did not relent. It was up 2%, 3%, up 4%, up 2%, up 3% every day for like a month and a half. And the mental strength that it took to hold that trade to completion, like to hold it all the way through, was hard, man. Like mentally, every single day, I'm looking at the dumbest, biggest number. I'm like, dude, this was years of salary for me when I got out of college. And I was holding on to it, and it just rocked and rocked. It was because I took this trade on a pullback with a relatively tight stop, and it never looked back. So here's the thing. Try holding them for years. I got other accounts for that. But I don't, and that stuff I'm not so active. That's more just, I sat in gold since 1200. Good for you, man. That's fantastic. So, but anyways, from an active trading perspective, where I'm staring at it every day, I'm studying what I'm doing. I'm, it was like so difficult to hold on to this trade. But I promise I'm getting to a point. In order for me to get to that trade, I had to take a bunch of small losses in a row. Like I had to enter, get stopped out, enter, get stopped out, enter, it goes in my favor. Oh, this is the one. And then it stops out, right? So to catch that trade, I had to sit patiently for months and months of small losses, tiny wins, and then the big one came. That style is why I say it is simple to do, but it's really, really challenging mentally. Because what you don't understand, if you're newer to trend following, like trend following means you are following the trend, and that means that you don't make additional judgments on the trend. Like if you're a trend follower, that means you follow the trend. You don't try and get cute with it and say, hey, I'm in. Oh, well, it's run up. So let me take some profits. That's not trend following. That's calling tops and bottoms. If you're a trend follower, you're long. Let's say you're using this moving average. You're long all the way until this thing breaks the close or closes below. Like that's an example. That means you give back chunks of profit. That's painful too. Right? If you're a real trend follower, let's say that you were looking at this thing and you shorted gold right here. A trend follower does not take profits right here because there's support. Nope, that's not trend follow. Like, I mean, it is to an extent, like you're trying to ride the trend. But what I'm talking about is what I like to call the TTF strategy, the true trend following strategy. True trend following is letting the trend break before you get out of that trade. And that is where the majority of a lot of my profits have come from. Now, not just the trend, but from the macro trend as well, right? Price trend and macro trend right now are synergizing beautifully for gold. Now, like I said, I'm not in this gold trade. I really wish I was. There's FOMO going off, but there's nothing I'm going to actually do about it. From an action perspective, I'm not going to chase gold. I'm going to wait and see if I get some pullbacks. And if I don't, I'm going to cheer on my friends who are long gold, and that's it. If gold does pull back, wonderful. 4250 to 4200 looks really attractive. For long side trades, betting the continuation. This is the most obvious trade for my style of trading out there right now. You've got a breakout taking place on gold. I'm rubbing my hands together looking for a pullback that may never show up. That is trend following. It's frustrating. Trading is frustrating all the time. There is never a time in trading where it's not frustrating. Never. When the trades are even going well, you're thinking, oh, I could have put on a little bit more size, or I didn't take this in all of my accounts, or I missed, this opportunity to exit the trade or whatever, right? Like there's so many reasons to be frustrated with trading that you sort of just have to accept that this is just a grind all the time. And so right now, one of the current grinds for me is like, okay, I have a bias on gold, a strong one at that, but I'm caught waiting for the opportunity. Always, like 100% of the time. Trading, if you're thinking in your head, you're like, well, I'll figure this out and it won't be frustrating or mentally challenging at some point. I'm telling you, I have been fortunate to do very well in markets. I've done this for 10 years. It never gets easy. It's a grind. It's not an easy way to make money. But I still love it. So I think that's a requirement, by the way, to be a profitable trader, is to love it. You have to enjoy it. You have to enjoy what you're doing here. Anyways, that's the summary on gold. I love gold going into CPI. I think yesterday I posted a little thing that did really well. Basically, I pointed out that I actually don't know how CPI comes in tomorrow in a way that really seriously makes me bearish on gold. Let me explain. Short term, sure, it could cause some spikes one way or the other. But let's just say CPI comes in higher than expected. Okay, if CPI comes in higher than expected, traditional edge finder logic is that would be bearish for gold. And I would argue that it is actually bearish for gold on that one singular metric in the short term. That would be bearish for gold. However, we can't ignore the context. And this is one of the most common fundamental problems that people do. If you're a fundamental macro trader, so many people who do not use a tool like Edge Finder, and yes, this is a plug for our tool. You absolutely should buy it if you do not own it. Look, what people do is they pay attention to one metric at a time. Because the way our brains work, you can't map all this out in your head. Our software is meant to keep an updated rubric here for you on all of our metrics. So we have CPI coming in on Wednesday. Tomorrow, we're expecting a 3.4% print. What a lot of traders will do is they'll trade the CPI number. They'll think just about the CPI number and how that impacts gold. But in my opinion, you should not do that. In my opinion, macro is a story. This is one piece of the puzzle, right? Here's my puzzle piece, right? Here's my one puzzle piece out of many. You can't see what the painting's all about if you're just looking at one puzzle piece, okay? And that's what a lot of fundamental macro traders, that's where they go wrong, is they look at one. They don't look at the full picture. They look at one puzzle piece, okay? So CPI tomorrow, yes, it does matter. But if CPI comes in higher than expected, how do I think about gold? Okay, well, I think that one variable would be bearish gold if CPI came in hot. That'd be strong for the dollar. But remember, let's look at the context. Consumer confidence missed. Services PMIs missed. GDP numbers missed. Non-farm missed.
ADP missed. Jolt's job openings missed. We have a lot of dollar bearish stuff that recently hit. And I think that's been perfectly a really nice little indicator here of the flip in the dollar strength, right? So for months, we stayed, hey, don't mess with the dollar. Dollar looks strong. Now, dollar looks a little softer. You've had some macro turnaround that I think is really worth paying attention to. How would you recommend to use these data points as an intraday trader? Oh, absolutely still relevant to intraday traders. I'll talk about that in just a second. But understanding the context is really critical here because CPI tomorrow, if it comes in higher than expected, you also have to consider that the economy is a little bit slow, or not slow, but it is less upbeat than what markets had been anticipating. And the jobs market is same thing, a little bit slower than anticipated. So even if CPI comes in higher tomorrow, where that starts to make me think is, well, that's stagflationary concerns starting to maybe trickle into the market. If inflation is rising, but economic growth is simultaneously weakening, you have a scenario where it's hard for the Fed to hike rates, yet inflation's going higher. That is a very bullish environment for gold. Ultimately, gold wants to see lower interest rates and it wants to see a lot of money printing. If you have inflation rising, but the economy is slow, it capsizes how much they can raise rates. If you understand that, doesn't matter if you're a swing trader, a day trader, a scalper, a momentum investor, a long-term investor, a value investor, doesn't matter. If you understand that context, that tells you a tremendous amount about what markets may do next, right? So that's where I think smart traders this week, we talked about this yesterday and the day before, Sunday video, Monday video, and today. That's why, in my opinion, gold continued to thrust higher. It kept pushing higher, even with a higher oil number yesterday. Oil jumped, right? Gold went up too. I'm trying to explain this, putting some game on here. Inflation almost doesn't matter to the market right now because it's like, wait a second. Oh, it does. But it almost doesn't matter in the sense that economic data has been lower than anticipated. So the Fed may not hike rates anyways. Boom, gold ran up. Smart traders are not waiting for the CPI print. They're understanding the context and they're trading it before it even gets here. You see what I'm saying? This is why if you want to be quote unquote good at this stuff, it takes a lot of learning, a lot of practice. We spotted that Sunday, Monday, because I've been doing this for a really long time. Now, granted, I didn't go long gold, so I shouldn't pat myself on the back too much. I'm just pointing out that you can start to kind of get the context, the way markets move by studying macro. It is a storytelling mechanism. And if you can piece the puzzles together, you can see what the picture looks like before the puzzle's done. That's my analogy for the day. Yeah. Isn't actual greater than forecast good for the currency? Well, it depends which metric you're talking about. Higher inflation than expected is good for the currency to an extent. It is generally perceived as good for the currency. Here's why I say to an extent. If the economy's in a really bad spot, higher inflation is just rough. Like that's just challenging because then it's hard for a central bank to hike interest rates if the economy is hurting. Now, I wouldn't say, I want to clarify, the economy in the United States is not bad. It is actually quite okay. It's just that the market had expected it to be phenomenal, right? You've got these expectations coming in, 2.1% GDP came in at just 1.5. Services PMIs were expected to be 54.5. They came in at 54.1. It's all about what the market expects versus what the market gets. That's what this heat map automates. It looks at all of it for you. Anyways, if you don't have Edge Finder, if you want to try it out, I'm going to drop a link here. If you would like to try the Edge Finder. So we just launched a way where you can actually get free access to Edge Finder. Click this link, by the way, if you're interested in that. If you would like some information about how you can try Edge Finder, scan that. Click that link that I just dropped there, and it will share some details. The other thing is that with that, you get free access to our course on how to use Edge Finder, as well as our course on fundamental analysis.
So if you're interested in that sort of stuff, if you want to start getting a better grasp on this stuff, we've built free courses, like actually free courses on how to start using fundamental analysis. Granted, it is also through the lens of using it with our software. So if you're an Edgefinder user, you can also just navigate to our website. If you already have Edgefinder, take some time out of your day. I'm telling you, just spend 10, 15 minutes a day doing this. Head over to a1trading.com. And then under, if it loads here, our menu's not loading for some reason. Let me try it. There it goes. Under tutorials right here, see advanced market scanners, go under tutorials, read about every single one of these. I'm telling you, you will learn a lot just going through all of the stuff that our team has been putting together on the website. Each one of these things, we've built a guide on how to use them. So again, that's totally free. Gives you a chance to kind of just learn the thinking behind Edgefinder. So let's see. Let's see what else. S&P 500 slightly positive this morning. I do think that inflation is not so back and forth for S&P. What I mean by that is S&P, I think if you have higher inflation, it probably comes down. And if you have lower inflation, it probably keeps moving higher. I think that one's a little bit more obvious here. Stocks just want to see lower borrowing rates. When it comes to stocks, let me just see really quick where we're at with this. S&P 500, mixed data there. Here's S&P. So fundamentals looking a little soft. COT, a little bit of selling came in, so institutions took a little off. Crowd sentiment signals getting a bearish reading. That means that the crowd is very bullish on this. We talked about this yesterday, but let's go look at our put call ratio really quick. Put call ratio for S&P. Let's see if it got more crowd bullish. It did actually. Okay, so here's the S&P 500 on a put call ratio basis. So crowd sentiment is still advancing in the direction of more calls. So that is very intriguing there. Let's just check on gold at the same time. Look at this, man. Gold. So this is another reason why I would love to see just a couple days down on gold. Again, I'm not betting that I think it will, but look at this. Crowd sentiment on gold is like ravishingly bullish. Okay. Net options volume, check this out. This just takes call volume on the day minus put volume on the day. Let's go take a look at our gold really quick. Look at that. This makes me, like, if I'm looking at gold, that makes me nervous in the sense that I think that that is primed for a bit of a retracement. I'm not saying necessarily it has to crash because I do think that the dip gets bought on gold, but this sort of feverish bullish demand to me is a red flag. So I would actually say more likely than not, I think we probably get some sort of a reset in sentiment here on gold. And what induces that sentiment is usually a drop in price. So I'm not here to say, oh, I'm going to short gold because sentiment's getting one-sided. No, because that's not enough for me to short something. I want context on the macros that we just got done discussing. Like I want to see inflation data and growth data, jobs data that sort of matches that thesis. Then there might be a short there, but there's not a short there for me right now. By the way, I've got a kitty cat here. Let's see if she'll say hello. She is, oh, she's up and at 'em today. She's an old girl. She lived on my porch for a year and a half, and now she lives on my lap. But yeah, we took her in because she's getting old, and we couldn't see her out there in the winter again. It was too sad. But she is she loves being a house cat now, so it's been awesome. But yeah, so when I look at gold, crowd sentiment is a little too stretched for me. Doesn't mean it has to reverse in the short term, or it doesn't mean it has to like completely fall apart. But I do think that gold has some room to kind of correct, go sideways, or pull back here. But we'll see. Silver is actually down sharply compared to gold today, down 1.15%. Let me just also take a look at like things like Dow Jones, just see what crowd sentiment's looking like here. see, that looks very modest. So if you're looking at an index like Dow Jones, I wouldn't be surprised if this one keeps going, right? If we kept moving higher. Prizrak, Nick dodging my question. What's your question? If fundamentals news, okay, I found it. If fundamentals, news, momentum, and volume align so well, why not drop timeframes to not miss such an explosive move neck? That's a good question. I just like the 4-hour chart, the daily and the 4-hour chart. I find it to be a lot less noisy. It fits my available time for trading better. I don't personally like the 1-hour chart and below. I'm not saying it's not useful, but the 4 hours is as low as I usually will go. I may look at the 1 hour, but I generally am a swing trader. Through and through, I'm a swing trader. I don't like the intraday stuff. Just not for me. Let's look at oil. Yeah, let's do it. Analysis for oil. Okay. I do want to just see really quick on oil. Okay. So let's see. Oil sentiment also, it leans bearish for sure. Let's see what else we have. Put call ratio. Let me just see here what we've got. Put call ratio for US oil here. Yeah, so crowd sentiment is a little bit pessimistic on oil. Not that that's the only thing, because it's not, but that's going to make me a little bit more cautious. Yeah, I'm going to see it right here. That sentiment score is flipped the other direction for that reason. I would say oil, I'm going to lean a little bit pessimistic on, to be honest, simultaneously because I just think context-wise, I think the White House doesn't want to be in Iran anymore. That's an opinion I have. But on a more data-related note, economic growth coming in really soft hurts the demand side for energy. And I just think that this is my take. This is my opinion. And I may make longer term sort of like investment / position trades off this, but I won't take a short-term trade off this. Longer term, I think these yields could put some pressure on global economic data. Like yields globally are rocketing higher. And I think that tightens up the monetary, kind of flow of things. They're at the highest levels that we've seen since like January of 2025. Gosh, if you've been someone waiting to buy a house, it's been rough. My wife and I bought a house a year and a half ago. And I think I have to say, it's probably the best bonds trade I've ever placed. When did we, okay, hold on. Let me think about this. Let me go to my 2024. Okay. Yeah, it was right here. So, I mean, we basically got our mortgage right around here. And our mortgage rate is 5.25%. How did it get so low? Well, we did a 7-year adjustable rate mortgage, knowing that we could be more aggressive on paying off the house if needed, if interest rates moved higher. But 5.25% feels like a steal these days, whereas, the generation before us would scoff and say, I've got 2.00%. Dummy. Should have bought a house when you were 7 years old. Anyways, guys, we've got Alan Perez. He is back for another round of, well, actually, no, he's not back. He's here for a very long round of going through markets. I hope he's got his coffee ready. He probably does. If he doesn't, he may need to put a pot on. Oh, he's got it ready. I can see it in the background. Guys, you're in good hands. Alan Perez is up next. Hey, last thing I'll say, try out the Edge Finder. We have new ways. We have new devices on how you can try Edge Finder, new course material, new tutorials, new ways to access the tool for free. If you're interested in doing that, take a second, scan this QR code or click that link and sign up for a trial. Get access to our tools. See if they're right for you. They are absolutely game changer if you're someone trying to be a macro fundamental trader. Up next, we have Alan Perez just after this quick break. Stay tuned.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream, or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Can you hear me now? Okay. Good morning, everyone. Good evening, good afternoon, wherever you guys are watching this. I did not make the same mistake that I made yesterday. Okay. So this time I do got my flip-flop beans and cup of coffee there. So we are in good shape here. We have a little bit of a longer segment here. So let's make it fun. Let's make it impactful. Hope you guys are doing fantastic. Anything that you guys are watching, feel free to drop that into the chat. We can go ahead and discuss it together as a collective group. But if not, we'll go ahead and go top down like we always do. Let's see. Alan will definitely regret sharing the sparkling water story with us yesterday. Look, man, it's something that if you were like my family, they hate it, man. They hate it because we'll be hanging out in the background. And if I'm like drinking a beer or two, I'll have to step aside and release some air. But nah, it's all good. It's all good. You guys are family to me, so you guys get to know the inside scoop about my burping dilemma. Ever since Alan started drinking flip-flop coffee, he has turned into a gold monster. That's funny. That's funny. It was a coincidence, man. Let's talk about gold. I know you guys are loving gold here. You guys are watching it like myself. Let's go ahead and see what happens. Okay, so let's go to 4-hour time frame. This is my markup here on the gold chart. So this is kind of where I'm at. And you know what? I think that we've made some new structure. So, and what I mean by that is I'm going to be trailing this trade here along the way. And inevitably, I will be taken out. But this is similar to Nick. Very, very much similar to. In fact, this is probably the way Nick would approach this, right? You have levels of structure getting taken out. You have a break, retest, that level holds. That is now support. Another break, retest, level holds. Now that supports. You're getting another break, retest. We'll see if it holds here. So what I'm going to do, right, is I'm just going to go ahead and move this stop loss and just trail it further a little bit. That way I'm just following along with market structure. So I'm going to do that now. It's going to do that, confirm it. Cool. And then as far as a take profit level, right, I have this level in mind right here, which is that 200-day moving average, that 4,500 level, right, of resistance. But again, I'm not going to cut myself short, right? If this thing decides to continue going higher than that, maybe you surpass this 200 moving average and you continue higher there, then of course I would just go ahead and just move this higher and do so, right? Because depending on what we see tomorrow, CPI, if it's extremely cool, you could definitely see a quicker move to that 200-day moving average. In fact, I kind of didn't realize or anticipate us getting this far up here relatively quickly. So it's kind of what I'm doing now, trailing structure here. We are at this level here, this level of what could be resistance. You can see on this chart on the left hand side here. So I'm not going to turn this into a green support level just yet. I really need to see price trickle up higher there and hold this level. But until then, I'm just trailing structure, right? So doing what I can there. Can you check the ADP data that just came out today? Yeah, let's see. I didn't even know that was coming out here today. Let's see ADP. Am I missing something here? I just see this headline: US ADP from FX Trade. US ADP employment change 4-week average drops to 8.25K. Am I missing something here? I'm seeing something else though. I'm seeing Qatar's foreign ministry spokesperson: negotiation between Oman and Iran now in advanced stage. Pakistan's interior minister arrives in Tehran for talks. Okay, so people are hopping into Iran over there. What am I seeing here? U.S. forces fire a Panama flagship attempting to run blockade on Iranian ports. So lots of things going on here, I guess, today on the U.S.-Iran front. Are you guys as frustrated as I am on this thing? Because I definitely am. Let's see what the market's doing. how long ago did this come out? This was about this was some time ago. So the market's definitely digested this. So nothing crazy as far as the reaction goes. Markets are just chugging along here. What's oil doing though? Flat on the day, literally 0.04, 0.02 on the day. So nothing crazy on that front. It's been a quiet day, much anticipated, I would say. Leading up into these important events, you do have just choppiness, right? Like dollar index has been just kind of hanging out within this range here, nothing much going on. So that's as expected. But what do you guys thoughts? What do you guys think, right? Like me personally, right? Let's talk about inflation and stuff. We saw relatively lower oil prices in June, right? And that translated into lower inflation. We're now seeing somewhat lower oil prices as well, right? If you think of this level here at 75, and then we were at one point at the 92 handle, but we could say that the mean, the average would be somewhere like within 82, 80-ish, right? Do you guys think that translates into lower inflation or sticky inflation, or is inflation cooling for other reasons? I'm curious to know your thoughts on that. I think that we may get a as expected inflation print. I think it would be an added plus, an added bonus if you were to see something cooler than expected. But I think that we'll probably see something in line. But what are you guys' thoughts? Alan, DXY, go over it slowly. Let's go over DXY. So DXY is going to be very important tomorrow. Let's go over CPI because I was looking at this Edge Finder chart here right before I was coming on the stream. And let's just look at what's been going on recently, right? So inflation, this is going back, I think it's 9 months that I have this selected, 10 months. This is 10 months inflation, right? You had inflation at 3%. And we're just going to follow this right here. 3%. Oops, wrong one. Inflation was at 3%. Sticky. And then it started to cool off a little bit. And then right here, March 2026 is when the war in Iran went ahead and started. So there's definitely a correlation with the war in Iran, higher oil prices, and inflation, right? Oil is typically known as a forward-looking indicator for inflation. It's a direct input. So that makes a lot of sense. So March 2026, Iran war starts to kick off. It starts to escalate, right? April 2026 and May 2026 is when we just started shooting up higher, right? So from there on, you have inflation making progress to the upside, and it started to get elevated at one point at 4.2%. Now, in June, we saw this. In June, you saw oil prices meaningfully lower, right? Meaningfully lower. This is very good, right, for the inflation story. And so as you saw lower oil prices in June, you saw that the print here, the most recent print, was way lower than expected, right? From 4.2 to 3.5. That is a meaningful jump. Now, what does this mean for the dollar? Because you asked me to go over the DXY. Well, higher inflation, right, means higher yields, and higher inflation, the way a central bank would fight higher inflation would be through raising interest rates, right? Making spending more restrictive, slowing it down a little bit. So with that, the dollar index is or was shooting higher, right? Similar with oil, right? War started right over here. You have oil higher, inflation higher. The expectations for central banks or the Fed to be more restrictive higher. And now you're starting to see something different. You're starting to see some kind of a topple down on the dollar index. Why? Well, if you look at this right here, this upward trend and then a kind of fade, and you look at this chart, the CPI, you have an upward trend and then the fade, right? It's very much correlated with inflation, oil, all that good stuff. So with the DXY, what can happen is basically this. If you were to see inflation come in way lower than expected, maybe you print something 3.4 or lower, that would continue this trend to the downside, and that would likely continue DXY to continue lower. At that point, what does that look like from a trade perspective, right? Because we all know what it could happen. I think we can all agree here that lower inflation means lower CPI and dollar softer. But what does that mean for a trade? How do you extract value from that? Well, I would say that if you were to break some key levels here, depending on what chart you're looking at, but let's say DXY, we're monitoring DXY and you have this level here and this level here. Well, if you were to break this level here, break, retest, and continue lower, then you would really have to look at what happens at the 200-day moving average, right? So the kind of dilemma here is that if you are in no trades at all and you're looking to take a trade, you're kind of like in no man's land, because you have this level right here, 100.5, this level of resistance, but then you have support here at 99.25 level of support. And price action is right in the middle. So what do you do, right? So inflation is cooler. You would need to see a break of the 200-day moving average, a retest of it, and continued lower for you to justify getting in this trade and continuing to catch the dollar unwind, right? So that's kind of how you would extract value there. Price is already extended a little bit, so you don't want to just blindly sell now because you don't know what the CPI print is going to be tomorrow. But then you also like want to be mindful of the technical structure, right? Because what could very well happen is you get a softer CPI print in the dollar index, right? But for whatever reason, you get to this 200-day moving average, and then you have dip buyers of the DXY, right? Dip buyers of dollar step in right here and take this higher, right? So you want to like see the CPI print, but then you also want to see the technical confirmation as well along with that to justify selling at these relatively lower prices than what we've been seeing, over here, or over here, right? So I hope that makes sense. Now for the bull case, different story, right? If you see inflation start to pick up again, well, you are near support, near that 200-day moving average. At that point, it would make sense to just buy DXY. But then the other obstacle would be on the flip side would be 100.5. Let's say DXY gets a little temporary bid, and then you hit this level of resistance here. That would be an opportunity for the bears to go ahead and take it lower and see if they're really winning this story or not. So with DXY right now, it is very tricky. So this is what I will share here with euro dollar, how I would play this if I were in your shoes and I didn't have any positions on. I'm going to go ahead and basically remove this here. I'm going to remove this here as well. And this is the play, right? So when it comes to trading the DXY, I personally prefer trading Euro USD because it is basically the inverse of DXY. Okay, so let's play the game. If you get cooler inflation, right? Cooler inflation, two things happen. Dollar softens a little bit and euro dollar picks up. But here's the thing, same thing. You're stuck in the range. You're stuck in the middle here. So what do you do? Well, one, if you get a pullback of some sort, I'd buy it there. Two, you would have to overcome this 200-day moving average and this level of resistance to justify a technical confirmation to take it to the upside. That's what you would play for euro dollar. So this is scenario 1 over here, and scenario 2 is right over there. That's it. You don't want to mess around inside this because you can get chopped into pieces. Things can go either way. It's very simple. On the contrary, let's say you get a super hot CPI print, dollar strengthens. Likely than not, you probably don't see euro dollar, shoot up higher and then reject this. I wouldn't think so. I think what you would likely see is just a softening euro dollar, so break and retest like this. At that point, the only thing you would do, or I would do, is just entry here, right? So break, retest, continue lower. So contrary to the other one, if you were to get a softer print where you would either wait for a pullback here or here, if you were to get a hotter print, I would wait for a kind of breakdown of these technical levels at this area right here. So that's what I would play for DXY, right? So right now you're in no man's land. You're in the middle of these two zones. You really got to see, one, what the print is, and then wait for technical confirmation in either way. All right, let me look at the chat here. Do you really believe those inflation numbers? It's not about what I believe, man, because you have so many different indicators, right? You have your trueflation that's saying one thing. You have your government data that's saying another thing. It really does not matter what I think. Similar to like a lot of people were giving resistance or questioning the jobs market data. Like, is it really that good? Like back, if we reflect back some time ago, just like, people were questioning the credibility of the data. But at the end of the day, it's not really what our opinion doesn't matter. It's what the market interprets and how it digests it. So you know, you could have your reservations about the integrity of the data that's coming out, but me personally, I just reflect and I kind of go off of what the market says. And if you see a cooler print and the market takes that as softer DXY and gold higher and stuff like that, then the market believes that data print. If you see something otherwise, then you have to go with it. For example, I can reflect on the most recent Fed meeting, right? You had, or not the most recent, was it the most recent one where the one where Warsh was, damn, did it already pass? The one where Warsh was basically trying to talk down, right? The inflation story and stuff like that. He was trying to appeal to the short end of the curve. The market caught on to that, and they said, you know what, we kind of are not really too faithful in you, right? We kind of have some questions, some reservations. So you saw the short end of the curve go lower, but then the long end, the one that prices in risk, shoot higher. So that's an example of like the market calling bluff and choosing its own path per se. So it really depends, right? So reflect to the market, revert to the market, and that's how you go about it. Let's see. Euro USD and the dollar trade is trash. Now too rangy. The capital flow is in crude metals, is picking up bonds and Bitcoin. Yeah. So it depends on what you want to choose, right? Me personally, ball out. I'm in a euro dollar long position, so I'm kind of just writing that thing too. So and it's a risk-free trade. So if I can, you know, participate and dabble, maybe euro dollar is not the best way to go about it. But if I'm already in a position and I'm already writing that thing, might as well just extract it and play it along as well. And same thing, right? I completely agree with the metals. The metals is probably the way to be right now, right? Like if you look at this chart, if you look at gold, let's just compare the two. Let's look at this chart, right? Clear uptrend, strong momentum, moving up versus this chart. Which one do you want to participate in? Definitely the latter, gold, right? So it's you know, just your personal preference. Some people like to trade FX, others not. I got into a euro dollar position, so I'm kind of having to navigate that. But if I had a preference, or if I was flat, if I was completely flat and I was looking for opportunity, I think the best opportunity will be in the metals for sure. No question about it. Let's look at Aussie dollar. So Aussie dollar RBA meeting last night where I live. Somewhat hawkish. I would say it was hawkish. They left rates unchanged, but they definitely opened the door and kept it open for further rate hikes. I think the next one is priced in at November with a 50% chance. So definitely hawkish there for Aussie dollar, giving us no pullbacks whatsoever. So we'll see what happens there. If you were to get a super hot print in CPI tomorrow, and you have Aussie dollar fall a little bit, maybe buying at this level here, this relative level of support would be nice to try to catch an upside move there. You can see here that this level has been quite nice for some time. So this will support here, support here, support here. You have the 200-day moving average right there as well. So if you were to get some kind of a dip in Aussie dollar, I'm actually starting to like it a little bit more. So I do like that for sure. But we'll see. We'll see. It also, you know, raises the question, if you were to get a super hot CPI print and you have some dollar strength, how long does that last, right? For example, does it last all the way up into 100.5 and then you have sellers meet you there and take it lower? Or does it last into 101, 102 again, right? And if it's at 102 again, well, what does that mean for this chart here? Is 102 on DXY translating into this level on Aussie dollar, or this level, or this level, right? It really depends. So that's kind of how I would look at it. But I'm starting to like the Aussie dollar to the long side story a lot more. In fact, let's go to top status page and see what we're looking at as far as winners and losers here. So let me see. We're going to take off the neutrals. We're going to take off crypto. We're going to take off this one. Let's see what we're looking at. So pound dollar, very bullish, 11. Pound Swiss, very bullish. Aussie dollar is very bullish. Kiwi's actually softer than Aussie as far as score goes. The pound basket is still doing pretty well. Again, we discussed it yesterday. I was trying to look for opportunities in the pound basket, but all of them are pretty extended, and there's really no pullbacks as of now. But I have my alert set, so we'll see. And then you have dollar CAD, dollar Swiss. Let's talk about dollar CAD. I talked about it yesterday. But in the event that you do have a hotter print of inflation in the US and dollar catches a bid, I really like dollar CAD to the upside a lot. I love this technical level here. This is this was previous resistance right here, turned into support. So we broke out of here. We're in this level here. We'll see if it holds on. You also have some pretty nice Fibonacci retracement levels too. Like, look at this level right here. So right now it is in between the 38.2 and the 50. And then below where that 200-day moving averages is the 50 between the 61.8. So anywhere here, I'm liking dollar CAD. So this is like really nice because it means that no matter what the release is, and if the data confirms the narrative or the case for, bullish case for dollar CAD, I don't have to wait for like a specific technical entry. I can just market order buy as long as I'm within the 38.2 and the 61.8. To me, from a swing trade perspective, the way I want to take this to the long side for a longer time, I like that. So that's what I'm going to be looking at for dollar CAD as far as a contrarian flip-flop trade. What are your thoughts on the 30-year? The 30-year being up there, it's definitely concerning. Ball out. I would say that you're having a lot of uncertainty, and you're having a lot of kind of doubt in a lot of things, whether it be our deficit or our debt, our national debt. You have the Fed concerns as well, so it's definitely not good. I don't know, man. I don't know. The market's definitely digesting it in its own way, and it's pretty resilient. So you have things or people saying like 3% is the new 2% as far as inflation goes. So did our tolerance kind of raise the bar a little bit? Maybe, right? So maybe it's not that impactful. We'll see. It's a slow grind higher, so nothing too crazy there. Like similar to Japanese bonds, where like they're certainly elevated. Like if you look at this chart, zoom out, certainly elevated, but again, it's kind of like a slow drift higher, and nothing has really happened over there, right? So like it's like a little, you can call it like a little bubble, right? That's kind of, it's happening. People know it's happening, but it's kind of just slowly drifting higher, and nothing's coming out of it. I would assume the same kind of happens with the 30 years. So ideally, hopefully something does come out, and you see yields lower. I think that would be off the backs of like the war in Iran just ending, right? I think that would give us a sigh of relief, lower interest rates, all that good stuff. Does it bring us all the way back to the 200-day moving average? Probably not, right? But if we can at least find our way back, retracing 50% of the move, I think that's a good sign. Or just seeing that the 30 years actually responding to that development, that would be good. But if you were to see, in fact, now that I'm speaking out loud, if you were to see the 30-year continue slow grind higher, if you see the war or the Iran war end, that to me is problematic. That to me is probably like, okay, maybe the market's like really fearful of this AI spend, this AI kind of bet that the world's giving on, and that stuff. Then that would be more concerning, I would say. But if you think about it, with the decrease in dollar purchase power, with the inflation at 3%, then a yield of 6-7% can sound as a new norm when you favor inflation would be left over. Yeah, I think I was talking with Alize about this yesterday, but like we're talking about real wages and all that good stuff. Like I think just the tolerance that the everyday person is experiencing, is their tolerance is just raising a little bit, So again, unless you like start creeping up higher and it just does not come down for any reason, like if you have a positive development like the U.S. and Iran war coming down, and it still stays sticky, then that's a little bit problematic, I would say. Yes. Nasdaq 100 help. Okay, let's look at Nasdaq here. Pretty resilient, I would say. So let's look at this Nasdaq chart here. Let's go to the 4-hour chart so we can better illustrate this. With Nasdaq, you have, this is the way I see the Nasdaq. This is my chart. Technicals are subjective, so give me some grace here, but this is the way I'm seeing it. You had the Nasdaq here being the relative loser compared to like the S&P 500, right? So you had this downward trend line here that was being respected, right? So this was keeping the Nasdaq under pressure. Then you had a break above it, you had a retest of it, and now you're higher. It's definitely a resilient chart, right? It's going higher. Would I buy this though? No, I wouldn't trade it. I wouldn't trade it at all. I think that it's still sensitive, and I think if you were to get a shock of some sort, and we all know that shocks and problems are inevitable, that being caught inside the Nasdaq at a level with a cost basis like this just gives you so much risk potential. With like, what's the reward potential, right? Like, what is the reward potential? You have this fear of everything. What is the reward? Are you gonna try to capture all-time highs again? Right? That's not too far away. You have, what is that, 31,000, 35, but then you have all of this risk to the downside. That's not a good trade for me. So ideally I wanted a tap into the 200-day moving average. That would have been nice. We got close to it, but not quite. So I don't know. Is this the dip? Maybe, maybe not. But me personally with Nasdaq, I'm not like I hate to disappoint, but I'm not like an intraday kind of scalper type person on the equity indexes. I know that it's super popular, like trading the futures like ES and NQ and all that, being super fancy with it. With the Nasdaq, I'm more patient with it. So I wanted that pullback all the way over here. Because we didn't get it, most likely I'm just not going to be participating in this for a very long time. So yeah, ball out for sure. So Nasdaq, I definitely agree with this right here. So Nasdaq was definitely weaker than the S&P in relative terms. So if you were to see the S&P fall, imagine what the Nasdaq does, right? So definitely for sure something to be looking at. And look at the S&P, by the way, just grinding higher. Does not care that there's a war in the Middle East. It does not care that oil prices are volatile. Doesn't care about the 30-year yield being at 2008 levels, like Fallout said. Doesn't care about none of that. It is just continuing higher. And so for me, that just raises a little bit of a red flag. And so I just want to be a buyer of dips, and I just don't want to be buying at these highs, right? Like whenever you see a crash or experience something like that, it's usually the weakest hands, the retail crowd, that gets shaken out first. And I would imagine that the retail crowd is all up in here. This is retail crowd. So don't want to be a part of that. I'll just be patient. I'll be patient. And when the pullback comes, I'll be grateful and thanking myself, patting myself on the back later. There's my favorite, Alan Perez. Oh, thanks, man. Yeah, man. Joshua, where you been at, man? I haven't seen you in the chat for a while. Okay, let's see. Let's look at Fed probabilities too ahead of CPI, just so we can get an understanding and we can kind of compare come tomorrow. So tomorrow you do, or for interest rates, you have a 50% chance of a rate hike come October. We're going to stay that way for 3 months. Not 3 months, I'm tripping. Up until January 2027. And then the chances that March 2027, you get another rate hike and you stay there. So market's anticipating 2 rate hikes. So we'll see how that changes. Gotham ain't going to save itself. So, yeah. Let's see. This at one point was 2 hikes. It looked like this. So definitely moving in the right direction, and right meaning not like right as correct, but right as in like moving to the right side of things. And that is not good. That's going to be better for the dollar, worse for gold, but gold doesn't seem to be caring too much about it. I'm curious to see what happens. I wonder, this is a question for you guys. We got to this level in gold rather fast. So with that said, do you guys think that we get to that 200-day moving average in gold by this week, depending on things that are moving, depending on CPI and all that stuff? Or are we starting to kind of top out a little bit? I'm just curious your thoughts. I think that we can actually get to this level here, this 4,500 by the end of the week at the speed we're going, especially if you have cooler CPI that just propels it. What are your thoughts on USD Swiss? So I liked USD Swiss. I still like it. I got burned earlier, so I'm kind of waiting for a technical confirmation. But this is my thought to a dollar Swiss. For one, you have a DXY unwind, you can say, right? Dollar unwind. The fundamentals are starting to look worse and worse for the dollar. So that gives me that kind of bias to the downside. You also have the edge finder telling us that we're very bearish. So I like that as well. The only thing that hasn't really happened yet is just the technical confirmation. So you have this level of resistance here on the weekly time frame. It's held it quite nicely. We had like a little bit of a fake out action, but nonetheless, we're kind of just hanging out here at this level. I would need to see this level break down lower for me to justify, shorting dollar Swiss again. It's been quite resilient, I will say. We'll definitely see what happens. If you see lower CPI tomorrow, hopefully that translates into like breaking like some of this. Like this is what I'm looking at, dollar Swiss. So let me go to a 4-hour. You can call this a trend line, whatever, but I'm just trying to see like a breakdown, like an actual breakdown of this level here. And if you do, then I can justify getting on a break retest. And then you actually have quite an opportunity to capture. You can capture 0.8, 0.9, or 0.794, which is the 200-day moving average, right? And depending on what happens there, you can kind of see, levels below 0.78. So I like dollar Swiss to the downside. Don't get me wrong. And also, too, I mean, look at this. This is a range bound pair right here. Like this thing just chops around for a long time. And it's very probable that we get all the way here or even all the way here. It's definitely done that in the past. So like if you measure the move out from there to there, that's 172 pips. And then all the way down here is 330. So I definitely like the opportunity there. It's just the technicals are kind of stubborn. It's like kind of hanging out here for a long time. So I really need to say a breakdown lower. But if you do start to see signals of further dollar unwind, dollar Swiss is one of those pairs that I want to really participate in. That and euro dollar long. Not gonna lie, U.S. equity market is the hardest I've traded so far. You know what's lucky? I can definitely see that as being true, man. I mean, you're having like these mixed signals. Like, think about it. Put yourself in the position right here. Who in their right mind would have bought blindly right here? Like, if you eliminate this candle, eliminate this candle entirely. I'm gonna make this black here. Eliminate this candle blindly. Who in their right mind would have bought right here? Right? It's like a falling knife at that point. Put yourself in the perspective. This is a falling knife. You're waiting for the 200-day moving average, right? You're like patient, and then it doesn't come. And then it just reverts all the way over there, right? And then you're seeing price action just chug along higher. But then who buys over here? When it's relatively weaker than the S&P, you're having that clear divergence, very obvious. And then you have other concerns. You're buying at the top. So it's like, you're not going to buy here. You're not going to catch a falling knife, but then you're not going to buy the top either. It's like definitely very hard. So just putting yourself in that perspective, like very, very challenging. Yeah, ball out. You could have just bought anywhere here and had a huge stop loss, but then it's like, I don't know. Tricky. Very, very tricky. Marco bought. Yeah. I mean, it's definitely a tricky environment. So like, you're absolutely right. Marco will be joining me here in about a couple minutes. So he'll be here. I have a longer segment. I swapped with Trader Nick. So I'm doing like an hour back to back, a little bit like 30-30. But Marco will be joining me very, very soon here. You guys asked me for Kiwi dollar. Let's look at Kiwi. What's it doing? Not the best chart, man. So to ball out's point, sometimes like the opportunity is not worth it. Like in this case here, look at Kiwi dollar just kind of ranging here, similar to DXY, honestly, where it's just kind of just chopping around. There's better opportunity out there. Like, would you rather play in this playground where you have a range of in the last 12 days, you've had a range of 44 pips, right? 44 pips. 12 days, 44 pips. Whereas gold, you go back 12 days, and you have a rally of 8%, right? 8%. So changes things, right? So with Kiwi dollar and currencies, a little bit tricky. I love currencies, don't get me wrong. I absolutely love them. But right now with Kiwi dollar, I think there's just better opportunity out there. I think the metals is definitely in play. I think the DXY is in play as well, but I would play it via euro dollar or pound dollar. The only thing with pound dollar is that it's already moving away from us, so there's really no opportunity there. But yeah, speaking of pound dollar, you guys are requesting it here in the chat. Tricky because you are at this level here of very, very solid resistance. So I wouldn't buy and try to capture this a little bit when you have this much risk potential to the downside. So the risk to reward on pound dollar, if you're looking at it with fresh eyes, ready to deploy, I wouldn't go into pound dollar. It's already moving. I think the train has left the station, so that makes it tricky. So unless you were to get a pullback into that 200-day moving average at 1.3400, not really worth taking it. Not really worth taking it. Let me get a flip-flop beans, man. I've it's been a minute. Fantastic. Duckling? That's a really good question. I'm sure a lot of people have the same question. So let me address it here for everyone. Alan, I'm not in gold, and I obviously want to be long. Where would you look for an entry if you were not in the trade? Would it be the 4250 area, 4200? Let's look at that. So with gold, let me go to this chart. This is kind of where I would look for. So this is, I'm going to go to the 4-hour time frame just so you can see my levels here. And let's just acknowledge these levels first. So 4-hour chart on gold. This is my structure, and my reasoning behind this was recent support or previous resistance, right? So we broke out. So if you were to get back here, this would be resistance. Here on my left, you have previous resistance here. So if you got the pullback into this level, it held up nicely. So this is a solid level. Over here, this was support. You had a breakout tested it back here. This will support as well. Again, this is resistance here. It's kind of holding itself to be true. So these are just my horizontal levels. Again, technicals are subjective, so take that with a grain of salt. But this is just it, right? These are my horizontal levels, and I've been trailing my stop here behind these levels, right? So right here, I'm right here. This level, if it continues to hold up firm, which it seems like it is right now, but again, that can change by the day. But if this level, if this was a break pullback and another level where it just continues holding, then likely than not, I just trail my stop here even further. So these are my levels. Now the question becomes, if I was not in this trade, where would I look to enter? Well, I will go a Fibonacci from low to high. Fibonacci from low to high, and then I would mark it out. So the first one is 38.2, which is right within this level here. So that could be a good attempt. The second level right here, which I would think would probably be better, is between the 50 and the 61.8. So that is around 4,200, 4,220. Like you said, 4,200, 4,220. So if you were to tap into this zone right here, this would be another good opportunity to go ahead and enter long on the long side. But your question was, or the question becomes, how aggressive do you want to be? If you want to get in at the 38.2 level, like somewhere within here, you would have to have a tight stop because it's very well probable that you can dip all the way into the 50 or the 61.8. So I would say maybe the better case is to be patient at the 50 or 61.8. That way, if it breaks down from here, it's clearly a break of structure, a break of trend, and you're not experiencing what could be very probable just drawdown, right? So that's kind of what I would look for. What's likely going to happen with me is that the gold story for myself is looking to be a lot more attractive, not even for the short term, but for the medium to potentially long term, especially if you start to see interest rate cuts start to be more probable, if you start to see lower inflation. Like at that point, I'm starting to think like medium to long term, like I just want to be long gold. Like that's going to be the new trade for me. So what's very probable is that, let's say by tomorrow, let's say by tomorrow, I trail my stop, right? I trail my stop to here. And then something happens and then price just takes me out and I liquidate position. I secure some profit. That'll be fine. I'm happy with that. You're definitely going to give back some profit. At that point, then, because I'll be taking out the market, I'll just be waiting for those key pullback levels. So I'm expecting that eventually I will be taken out of the trade. And when that happens, I'll be looking for the same pullback levels, either the 50 or the 61.8 to go long gold again. Whether that be the fib is extended from here to here or from here to the 200 day or from, whatever. That's kind of how I'm going to be playing it out. So am I still watching Bitcoin? Sluggy, I saw Bitcoin was down like 1 point something percent the other day. Is it even up? Let's see. Yeah, but I'm definitely watching Bitcoin. I want to short it, man. Let's see what's it doing. It's kind of just doing nothing. But Sluggy, you've been pretty active on Bitcoin, if I'm not mistaken, right? But this right here has been kind of hanging out here, where I'm trying to get to that 200-day, man. Bitcoin to 50K. Bitcoin to negative 50K. That's what I'm saying. Marco, what's going on, man?
Hello, Alan. I'm doing pretty well. The markets are kind of slow. So how are you getting on this a bit of a slower week, I would say?
Very slow. Very, very slow. I'm doing nothing at all. I'm just like trailing my stop on this one. I just tightened it up a little bit. And besides that, I'm just waiting for tomorrow, quite literally.
Yep. Like the only development that we had was first the Middle East. So apparently Iran mentioned that they were going to wait out Trump's term and wait for the next US president to try and do something. Trump said that he wants reparations from Iran. So like that whole thing cooled off. Oil is up. I think what we talked about yesterday is just going to continue basically for the rest of 26, like a path position where you just get elevated oil inside of the range and the strait being closed. And then probably in the next 2 to 3 years, they actually do build out the alternative pipelines and the alternative routes so they can fully bypass the strait and remove a lot of power from Iran, basically.
I think that's going to be the case. It seems like it's like that. Frustrating, but it we've seen this with the equity market earlier in the year, and it's definitely showing itself again here. But it's just not really considering what's going on in the Middle East. Like it's this whole thing. There was elevated oil prices, war in Iran, and the market is just chugging higher. Like if it's not even happening, you're starting to see that with gold as well now. Like gold is just coming out of the room. Chugging higher there, not even considering that yields are elevated, that inflation still could very well be a problem, right? Because we just had a one-off hit of softer print. What if tomorrow comes in hot, right? So the market is definitely just saying like, it's gonna go away eventually. So
Yep. I mean that's kind of what we're seeing, and also alongside with that, we had the second thing that happened, which was the RBA meeting. And it turned out a bit more hawkish than expected. The main chairman there, which I forgot the surname, but basically is Bremen or something like that. So Anna Bremen, I think it's that's her name. So essentially, she mentioned possible hikes in the future and inflation being a big concern. That's why the reaction was hawkish, which kind of fits my game plan in terms of buying the Aussie dollar, but the poly market odds have switched. So let me show you that. So let's add this screen and go to poly market, CPI July. And let's go to annual inflation. So yeah, basically you can see how the line switched again. And now the highest probability is for 3.4%, which is the exact same thing that we're getting on the Forex Factory news calendar, 3.4%. So the edge in buying the Aussie dollar ahead of the event is no longer so powerful. I mean, I can see that the market is leaning for a more for a cooler print than expected, but still I don't think there's a massive edge in buying the Aussie dollar before that. So yeah, unfortunately, it looks like that trade idea got negated, which means I'm kind of mostly staying flat. I'm mostly looking for pullbacks on gold, which could happen if we get a hot print, and I'm looking for the yen. Basically, I'm in a short on Swiss yen, so looking for the yen to appreciate. And also on top of that, I'm trading individual US stocks, buying breakouts. So that's kind of what I'm doing.
Okay, so you're still actually pretty active then. With Aussie dollar, I kind of my outlook on that one has improved a little bit. So I was thinking under the framework that they were gonna go from super hawkish at one point to kind of dialing back a little bit, but it seems like now they're starting to kind of become slightly more hawkish once again. So with Aussie dollar, I would be a buyer if you were to get some kind of a dip to that 200-day moving average. But if you don't, I'm just gonna let it do its thing. Like it's drifting higher, it's doing what it did before, so it is what it is. And I have no interest in buying here at the middle of these two levels here. So I'm just gonna stay away with Aussie dollar until then, until something changes as far as pullback goes. But other than that, I like dollar CAD to the upside if you were to get some kind of a hot print and you see a firm bid into the dollar index. So with this one here, you have this level of resistance that held up quite nicely. 200-day moving average right there as dynamic support. So if you were to see that, I think this is a pretty solid level anywhere within here, really, to buy dollar CAD and trade it to the upside, at least to 1.4100. Where at that point, if the bears are still in control, they could definitely step in right here, but at least I captured some of this.
Yep. Well, that makes a lot of sense, actually. I think the CAD is a weak currency alongside with the Aussie. Or sorry, Aussie is strong and CAD is weak. So like selling buying USD CAD may be a good idea if you want to try and go with dollar longs. So it's a good idea right there. But if we switch it up a bit, because this week it's pretty quiet, I think we're going to have to wait for that CPI print tomorrow, and then things could kick off. You said that the school started in the US, right?
Yeah, it starts tomorrow, I'm pretty sure.
Tomorrow. Okay. So because essentially once the school starts, a lot of the parents, they come back to work, so the volatility kicks back in. But from my research, like September is the month where the actual moves come in, when people actually come into office and they really start to put on positions. But I wanted to talk about prop firms. So what would be I was just making a video about a challenge that I'm doing on my channel. It's called the Road to 100K in like profits from prop firms. And in it, I mentioned briefly my game plan when it came to risk management for prop firms. So do you do a ladder approach, or do you just do a straight 1% risk no matter what is the drawdown?
Similar to my personal accounts. Like it's very dynamic depending on conviction, depending on, like, for example, with gold, me being or placing the order, I'm gonna go to this other chart because it's less noise. But I bought it right here. I'm gonna make this actually pink. Right over here. So given that it's relatively very cheap to compare price action, I'm like, you know what? Like I'm buying at a discount. You're seeing the technical factors and you're starting to see the fundamentals there. So it's very dynamic in the sense of like if a lot of things are aligned and my conviction is elevated, then I would take a bigger position. But if I'm like, for example, a lot of people raise the question, like, well, I want to be in gold now. What's going on? Well, if you were to get a pullback of this, like up to right here, then obviously my risk on gold is going to be a lot less than had I bought way down here. Like if I'm purchasing here on pullbacks, like I have open room all the way here if the move completely evaporates and goes away. So like that changes a lot of things. So as far as my approach to prop firms and stuff like that, very similar, exactly the same as to like the way I would trade my accounts. The firm that I'm using right now is FTMO. So it's very friendly to my style. Like they don't have actually a lot of strict rules. It's just literally just a static drawdown limit and your take profit, and that's it. Like you can hold over a weekend, you can trade over the news, all that stuff. Super simple and vanilla. So that's why I chose that firm. So that's kind of how I go about it. But definitely, depending on your firms, your more cost-effective firms, the trade-off is you get more rules and risk, things that you have to kind of juggle around. That makes it a lot trickier. Marco, you know this. I'm building a tool right now for prop firm traders. So basically, what I'm doing is I'm building some kind of an algorithm that's similar to Edgefinder, where it scans a lot of data and gives you like a consolidated kind of viewpoint of like bullish, bearish. I'm basically building an algorithm that goes over every single prop firm, all of the rules, because they do a very, very good job at hiding the rules and sugarcoating things. So I'm doing that, and basically it's like depending on the prop firm that you're trading under, you're assigned kind of a rubric, a rule book. And there it's like you're no longer trading blinds. So like if you're trading on a prop firm that has a 2-hour known use restriction rule, and it has an equity end of day drawdown rule, or whatever the case may be, every firm has different rules. You're trading with that rule in mind, and so you can't breach it. Like the terminal will literally reject an order if you are about to breach that rule. So it's very, very tricky. Prop firms are super like tricky, man. Like it's their incentive to go ahead and kind of breach you, right? So I'm trying to avoid that and at least show you like what you're trading against, right? So yeah.
I mean, like we recommend Ola Prime here at A1. By the way, so discount is A1 Live 20% off. Ola Prime is pretty good, but you have other firms which constantly change rules. So as they have a bad couple of months, they know that they have too many winning traders. So basically they change the rules to get them off, and then maybe later down the line they change them back. And I've seen that happen over and over again. Just a new rule gets implemented, a bunch of accounts get breached because they try to hide it as much as they can. So that freaking sucks, and it's one of the main issues with a sketchy prop firm. The way to find out about it is, Trustpilot is your first best way to go. Whatever you're doing or buying on the internet, you should always check the reviews. And of course, second thing is if you have a software that scans all of the changes, right? So that can work really, really good as well, because they do try to hide it in the white print. But if you have good software, you can absolutely catch that. I want to share my ladder. Maybe it helps someone, because from doing the video on my channel, I noticed that on one of my FTMO accounts, I managed to bring it out of a drawdown, and it was like $200 away from hitting the max DD. So essentially, I started this account on the 13th of August 24, which is 2 years. So I've been trading this for 2 years. And with proper risk management, and if you have an edge, you can actually bring yourself back from almost blowing the account. So you can see the balance, the lowest balance was 45,134, which is $134 to hitting the max drawdown. And I'm pretty much, not at break even, but kind of close to break even. So the way that I ladder on prop firms is basically, so 0 to 5%, I basically do 1% risk. Then let's say 5 to 8% drawdown would be 0.5%. Then you can do 8 to 10%. You can drop it to 0.2%. That should give you like, if you want to count it, it's 5 trades here. It's 6 trades with 0.5. And then it is around 10 trades with 0.2% risk. So it gives you like around 20 trades before you actually blow the account, which is much better than solely risking 1%. Like with this account, if I was risking pure 1%, this account would be long gone. But with this sort of ladder approach, I managed to bring it back up. And that's what I noticed. Like a lot of traders in trading books, they recommend when you're in drawdown, the worst thing you can do is increase the risk, because looks like your edge is deteriorating, so you should actually lower the risk. Yes, it's going to take more time to climb out, but that's the approach to not go into like 40-50% drawdowns.
That's really respectable, Marco, and it's really hard to achieve actually, especially like when the account equity is going down. When I was solely trading, when I left the bank and I went to trading independently, I experienced that. That was my only income, and I had a losing streak and I had a drawdown, and it freaking sucked, Marco, because not only did I not make any profit, but I still need to live and continue depleting the account, right? Taking small bits here and there. So that right there was very, very scary. And what I had to do, or what I did initially, Marco, was up the risk a little bit, and that only just dug myself in a deeper hole. And so after 2 days, or after 2 trades of like digging myself in a deeper hole, I was like, you know what, I needed to just chill out. So what I did was I reduced the risk by a lot, and I wasn't making a lot of money, but I wasn't losing a lot of money either. And what I really wanted to do at that point was just put a bottom in there and then climb out slowly. And once you start climbing slowly, it's not just the equity that grows a little bit or that flattens out or stops the bleeding, but it's more so like your inner self. Like you're like, okay, I'm more relaxed now. The bleeding has stopped, and that gives you a little bit more confidence. That way, when the opportunity does present itself, you can actually dial up the risk a little bit and start clawing back. But when you're like in deep drawdown like that, you need to just put a bottom in. Like that is your goal. It's not to make money, because you can't go from like losing to making. Like you need to lose and then stop the bleeding and then make it, right? There's something in between that needs to be done, and that is stopping the bleeding. So I definitely recommend that for sure as well. Like dial that risk down to like 0. Like to whatever that number is for you, 0.1 or 0.5, but just put the bottom in the account. That way, at least you're no longer thinking like, what am I doing wrong? It's more like, okay, this is a turning point here.
Yep. And when did you go full time with trading? Was that in 24?
Yeah.
24. Okay, cool. Yeah, I think like a lot of people get themselves into trouble with risk management, and I'm not going to say it's the most important part, because having an edge is the most important part, but risk management, again, if you don't do it properly, it's not going to work. So it's like a crucial part of trading. So having sort of lowering the risk as you go more into DD is one thing you can do. Another thing that professional traders do is they vary their risk according to their confidence level. So for example, 1% should be your usual size, but you can go 2% if you have a high confidence level with those trades that come maybe once or twice per year. And then if you have less confidence but you want to be in, you can go with 0.5 or 0.25. That's what I've been doing basically. So I do vary the risk according to the conviction level.
Yeah, and also too, like how much open risk do you already have? Like if you only allow yourself, for hypothetical, 2% of open risk at a time, so only, that's how much you can have at one time, cumulative of all positions, and you're already at 1.5, well then you're not going to put 1%, because then you'll be at 2.5% open risk. So you just got to go whatever your remaining allowance is. So for me, it's very dynamic. It varies a lot, and like everyone you see in trading is like, you got to have static RR. So it's either 1 to 2 or 1 to 3. And you have to do 1% per risk per trade. I don't think I don't think that's the most effective approach. Could it work? Absolutely it could, but it's not the most effective and realistic approach, because there's other variables that you have to take into consideration.
Yeah, it's good for total beginners to ground them and like not make them risk 5% per trade.
Sure.
So to just, because when I was starting out, that's exactly what I did. So basically 1% risk per trade, every trade, and a fixed, actually it wasn't a fixed reward to risk. It was actually a trailing stop loss. So I didn't do it, but I know what you're talking about. And at the beginning, it's helpful because you don't know what the hell you're doing, but later down the line, it can really limit the amount of profits that you take from the markets. And you need to kind of change it up. One more thing that I've seen traders do is they start the year with 1% risk per trade. Once they build a buffer, so they build 10-15% in profits, then they bump it up because they're essentially playing with the house money. So they have extra profit, which then they can risk for more future trades, and they can risk more. That's another approach you can do. So yeah,
I've definitely done that too. Like in the phase where like I just wanted to build fast, like you could definitely do that, but then you have to accept that you're only 1 or 2 trades away from being back to exactly where you started. So that's
yeah.
kind of the trade-off there.
Yeah. And also the last thing, I'm not going to keep you too much, but the last thing I wanted to say is in Market Wizards, the new book, if you read it, the thing that makes the Wizards different than regular traders is not the edge. It's actually that those guys that made $100 million trading stocks, they went heavy. They were running 20, 30% cumulative risk, which is huge in correlation. If you get a crash like COVID, you're going to be wiped out by 30, 40, 50%. And they did get wiped out by 40%. So if you can go deep, I'm going to say the dirty word, but I'm not going to say it. But if you can go deep with the risk, you can basically make millions and millions. But that's also a super hard thing to do, is slapping on a huge lot size. And it's absolutely not recommended for most people because most people don't even have an edge.
I would say like if you want to be one of the people that goes deep into a position, just have the understanding and the expectation that that happens every once in a while. So like don't be going deep into every single trade, because at that point you're just over risking. But there are definitely times where whether you like just build a big position over time and it just works out in your favor, or you just go deep all at once where it makes a lot of sense. But it's not something that just happens all the time. Like those are one handful of trades in someone's career. It's like it has to be the perfect brewing environment.
Yeah, like most of the guys in the Market Wizards, the newest one made, I would say, 50-60% of their profits in 2020. Like they've been trading for 10, 15 years, but most of their profits came from 2020 and 21 because the market conditions then were just crazy good. Super, I'm not going to say easy, but yes, easier than now. Absolutely.
For sure, man. But thank you for the convo, man. I'm excited for CPI tomorrow. It's a low market, so I wouldn't really expect much to happen unless you get something out of the ordinary with Hormuz or whatever. But yeah, man, I'll see you tomorrow. Thank you for the conversation. I wish you the best.
Thank you, Alan, and see you tomorrow.
All right, peace.
Goodbye. Okay, let us continue with the program. Let me see, what do I have here? I covered most of the watch list in my first segment, which I can repeat some stuff, but I want to take a look at stocks quickly because the market has opened. So I have a position in RHI, which is just around break even. SE, massive breakout. What the hell is this? Earnings. Okay, I'm going to remove this stock. If you don't know, instead of buying the SPY or the Qs, I buy individual stocks. And now is a really good time, really good market condition to buy individual stocks. So SE is out because earnings day is something I don't want to mess with. So RHI, I have a position in. Etsy, pulling back a bit. I'm looking for breakouts. So essentially, this whole strategy is built around a flag, a pole. Sorry, this is the pole, this is the flag, and I'm looking for a breakout out of the flag. Okay, so that's the strategy. Very simple. Again, I don't go super complicated because I have other strategies that I'm doing. But I'm just going to scroll through the watch list. PANW, not that bad, I would say. Rest of the stuff doesn't seem to be breaking out. Nah, not really. Where's Dell? Here it is. Yeah, rest of the stuff is not really moving that much. Anyway, so the main condition for buying breakouts for this strategy is the SPY needs to be in an uptrend, needs to be preferably at all-time highs above the 50, 20, and the 10 EMA. That gives you a very good market condition. So let me see some of the comments. Marco, your Fiance wanted the Birkin, that's why you started the 100K challenge. Well, that is true. She does want that super expensive bag, but we bought the Chinese copy, so she's happy. It's the same thing. It's the same thing. Like the Chinese copies of bags and all that fancy stuff, very hard to tell a difference. Okay, very hard. So if you want to make your girlfriend happy, just get her a Chinese knockoff of whatever she wants, and she'll be pretty happy. I keep the risk static, but after a losing streak, I add 0.1% per trade. Usually my losing streak has lasted 5 to 6 trades. What sucks more is the prop firm have a profit cap for first payouts. There's a bunch of rules that with prop firms can really screw you. Not all market wizards, but definitely a few of them had gone all in. Yeah, there's a couple of gamblers in there, but it doesn't take away from the skill because they managed to keep it. They didn't blow up. They just went super heavy, and that's what makes them different from me. Let's say I don't think I could go and handle 40-50% drawdowns or going all in. I definitely won't go all in on a trade, but even 40-50% drawdowns, which those guys have dealt with, I don't think that's for me. I know the Kulamagi guy, he went to 100 million in profits and then went back down to 50, 60. So he lost half, you can say, in open profit. Or it was actually banked profit, but he just kept on piling positions which didn't have an edge, and he lost 40-50 million from the equity top. Now, could you handle losing 40-50 million? I don't know, maybe. Gold, Marco Nikkei, Spanish, Timo Special. What time? Timo Special. What time is CPI? Nikkei, no retracement on gold. Lucas to a good market now. It's good for buying or sell. So, okay, Nikkei. Let's take a look. Nikkei. JP225. I mean, it's starting to improve. The risk that I see here is that the Japanese government really wants to push the yen up, make the yen stronger, which is a problem for the Nikkei because the Nikkei is quoted in the yen. See, JPY. So essentially, as the yen gains value, Nikkei loses value. That should be the market dynamic. Now, personally, I wouldn't want to play this at the moment because I'm bullish on the yen, because I'm selling Swiss yen. So Nikkei is not for me. What I do prefer is the SPY and the Qs. So the SPX and the Nasdaq through individual stocks, or maybe even an outright. So maybe even an outright position. Yeah. My top 3 picks are Swiss yen, I have a position in, Aussie dollar, looking for buy setups, although I have decided, well, I haven't decided yet, but playing the CPI tomorrow, I don't think I have a massive edge. Gold starting to well, it isn't really starting to pull back, but it looks really good to buy. It had a really clean breakout out of the trend line. Okay, really clean breakout, nice juicy momentum, juicy move, a lot of size behind it. So I'm looking for pullbacks I want to get in. This is also a nice bet on a bearish US dollar, okay, which I'm bearish on the US dollar. I think the Fed is not going to hike at all this year. I think they keep the rate the same. I think the current hikes are completely mispriced. As long as inflation stays below 6 to 7%, and no, I'm not going to do the 6-7 joke anymore because I'm kind of done with it. But if the inflation goes above 6 to 7%, then they may hike. But at 3.8%, they're not going to hike. That's how I'm seeing that situation. So I'm completely betting on a dovish Fed. I do want to mention the sponsor of today's video before I forget. So if you're looking to get funded, we talked about it. So I talked about it with Alan. Ola Prime Prime 20% off with A1 Live. Okay, so you can get 20% off with A1 Live on Ola Prime. As I told you, look at the Trustpilot. So go through the reviews. 4.5 out of 5. Look at the ratio of 5-star to 1-star. Read through the reviews. Okay, read through them. See what you think. Get some or join a Discord. Talk to the traders in the Discord. We have a couple of traders who have gotten steady payouts from Ola. And with the code A1 Live, you get 20% off. And also, they don't have consistency rule. They don't have a consistency rule. So that's a big, big bonus. If you're a swing trader, you know about this rule, and it can be very problematic. So Ola Prime doesn't have it on some account types. That is about it from me. So I have run out of time. Thank you guys very much for watching. You can catch me tomorrow. I think it could be a big one. So we need some sort of a catalyst. Markets right now are super slow. Nothing is really moving. Nothing is really happening. This week, very boring so far. So we need a catalyst. We need maybe the Middle East, but I don't think so. Other than that, we have the CPI and the PPI, so inflation prints. Thank you, and you can catch me tomorrow. So yeah, that's it. Goodbye.
Don't go anywhere, traders. The show will be right back with our next show host. But before we get back to the show, I wanted to mention today's live stream sponsor, Ola Prime. Ola Prime is one of the fastest growing prop firms that I've seen in the space, and they offer a super wide range of different account types. Whether you trade Forex or futures, whether you're a swing trader or you're a day trader, they have multiple different account types, and they have some of the most competitive pricing that I've seen in the industry. And check out this publication from Deloitte, who did an audit during a select period of time on Ola Prime and its payout legitimacy. One of the big things that Ola Prime is well known for is their very fast payouts. They have this posted up all over their website as one of their main reasons that traders like them. From what we've seen, they also have a very strong reputation overall within the trading space, and they are a proud sponsor of our everyday trading stream here. And for a limited time, if you use our promo code that you can see on the screen right now, A1 Trading, you can get 20% off any of their accounts. And using our discount code lowers the barrier to entry, meaning that your challenge costs you less and gets you that much closer to potentially getting a payout someday. Of course, to throw my 2 cents in there, I'm a big fan of not trying to get funded until you feel you are actually ready to do so. So if you feel you have the skills, if you feel that your trading is up to par, and you do your due diligence on Ola Prime to see if it's right for you, then make sure use our promo code to get that extra discount at checkout, and we'll be dropping the link to them down below in the live stream chat. You can also find it in the description, and we'll have a QR code on the screen right now that you can scan if that's easier for you as well. So thank you to Ola Prime for sponsoring today's live stream. Now back to the next show.
Catch me outside. How about that? How you guys doing? Every time Marco says you can catch me tomorrow, that's just automatically where my mind goes. If you guys know, you know. So anyway, I hope you're all doing wonderful out there. Coming on here to close out the show for you. So as always, throw out your tickers. Let me know what you're looking at. Another the last day before inflation comes out tomorrow. It's going to be interesting to see if the month of July was just a one-off with all the cooler inflation we had after 3 months rather, of spikes right before that. We had some pretty good spikes, pretty big spikes, which definitely have one or two of the Fed board members in a little bit of a tizzy, despite the month of July being cooler. So it's going to be interesting to see if it's the one-off or if it maybe continues, starts a new trend of cooler ratings. We shall see. So that's tomorrow. As always, we want to be careful when those come out and just make sure the weak hands kind of shake themselves out. And above all, we don't want to blow any accounts tomorrow, guys, on inflation. So looking forward to that tomorrow, but we just got one more day to get through before that comes up. So, yeah. And then, of course, you do have the Ola Prime code there, 20% off the account of your choice. Manually, just type in A1 Live on olaprime.com or click the code if you prefer that method. So, anyway, guys, yeah, again, just let me know what you're looking at. We'll just take a look at some of these alerts that I've had come out recently. Let me see here. So we had well, number one, when it came to oil, so we did have a bearish, just like a barely bearish score for a short minute. yesterday, and we bounced into that overhead supply that I was watching for a minute. Now, I was already skittish about it because it had already bounced into the 4-hour demand underneath, along with that put wall that we had. And so when we got our spike up, we did have a little bit of a trend line. But as price entered that zone, and I'm not sure exactly when it fell off the bearish list, but even watching it as it went into this zone, I just didn't really get a good trigger candle. So that's why I avoided this. And thankfully I did, because I would have definitely been stopped out. It is starting to kind of turn back around the other side now. Now, those call and put walls, sometimes, as Nick says quite a bit, since he's introduced this tool to us all, sometimes they can act as form of resistance turn support. So it's just something to be mindful of there. But at this point, I'm sitting on my hands with oil, especially since it has went back to neutral over here on the top setups. And again, I just didn't get my trigger candle, so stayed away from that one. Probably don't have a play on oil today. We'll see what inflation does tomorrow, if that kind of helps or hurts it, and we'll go from there. But yeah, just sitting on my hands, guys, when it comes to oil. I had a couple other alerts hit. Let's see, Aussie dollar. Now, we had Aussie rate statement come out last night, which they did stay as unchanged, rather. Okay, 4.35%. They did leave it unchanged. A little bit of, as far as notes go, slightly less hawkish than previous meetings, less hawkish hold. Policy is now judged somewhat restrictive, in quotes. Inflation is still too high and is not expected to return to the middle of the 2 to 3% target until late 27 or 28. Board says it is prepared to hike further if upside risks materialize. So yeah, that's just a little bit of the notes from that. But anyway, when that release came out last night, it just so happened we dropped into a little bit of a demand. Now, keep in mind, we were in a overhead supply. Okay, we were in a daily supply, 4-hour supply, a little bit of a confluence there. So no matter what, I was going to stay out of that trade anyway, because it's obviously a highly regarded red folder event for Australia. But just to go and show, hey, zones still work out quite a bit, even with the releases of those news events. So we had a 2-hour demand that I had drawn up here. We just wicked in nicely, again, right when that release came out, and now we are starting to push back up. If we did not have any of this overhead resistance right here, then, there could be a slight case that I might have maybe taken a little bit of stab out of it. And the reason I say that is because in this 2-hour zone right here, if I go by the rule of 4s that I try to stick by, 2 divided by 4, 2 hours divided by 4, well, that gives me 30 minutes. So when I go to 30 minutes and I take a look at the volume, this is where last Friday's NFP volume kicked in, which is what kind of helped create this zone of demand. Leg out was a big, lovely red candle. So a lot of volume there, a lot of institutional volume that took place there. Sure enough, when price comes back to the zone, more orders kick in, kicks price to the upside. But yeah, there was just no way in hell I was going to be risking anything on that. Again, here's our 1-minute chart. Whenever that release came out, it just barely wicked into the zone, wicked in a couple times, and then off to the races to the upside it went. So it's nice to see zones working out, even when I'm too afraid to take a trade based off of a red folder event. So that was Aussie dollar. At this point, I just want to see it kind of regroup and do like I drew yesterday. Let's break the rest, whatever remains of this supply, and that swing high like this, and then look for a retracement, because we do have that zone on top of a zone all the way at the bottom, like I showed you guys yesterday morning. So nothing else I can do up here. This is pretty high on the curve. I am not risking a buy anywhere in this zone area here, because we've already bounced into our confluence. And again, if it breaks and closes above that, well, then possibly. But if it doesn't, if it just comes straight down, be waiting for that big, lovely retracement all the way down to the bottom of the curve, which is our discount area, okay, for those zones. Stop loss underneath all this, like I showed yesterday. That way I can take advantage of 2 zones here. So that is Aussie dollar. That was that one. And then I had euro dollar that hit. Same thing. All these dollar pairs gave us a red candle from the NFP result, right? So we're dropping into this thing now. Now, again, just like Aussie dollar, it's bouncing into an overhead supply. So I don't know how big of balls I have today to be trying to buy, knowing that we're bouncing into the overhead daily supply. So you had daily supply, you had a big gap down, you had the volume picking up. It wasn't a yellow candle on a 4 hour or on a daily, but when we drop it further to a 4 hour, this is why I'm not getting into this trade, guys. Or 4 hour, 2 hour, well, even the 4 hour leg out volume, as you can tell, is a red candle. Lot of volume pushing down. No way in hell do I want to be buying when I see that liquidity right there. Okay. 4 divided by 4 is 1. Drop down to a 1 hour and see what we got over here. 1 hour, 2 hours, same thing. Red candles. Those are landmines, guys, that I try to avoid. So whenever I show you these zones, just know that it's 2 reasons I'm showing you. I'm not only showing you for spots I'm interested in buying or selling from, but I'm also showing spots where they could jump up and bite you if you're trying to buy in the direction of those zones. Okay. So that I think is probably the most important, because I know not everybody out there trades supply and demand like me. We've all got our own strategies. But that's, I think, a bigger contributor to it than just my signals themselves. Okay. Which I don't really do signals. I just like to show you what I'm looking at and throw the disclaimer out that it's not financial advice. So yeah, euro dollar, same thing. Just looking for a retracement all the way to the bottom, because even on that 4 hour candle, that 4 hour leg out down here, it's giving me another ultra high volume bar. Okay. So that's why I'm waiting on the bigger discount on euro dollar and Aussie dollar for that matter. And it's all because of this pesky overhead supply that we just so happen to be bouncing into. The resistance, the overhead resistance. Let's see here what you guys got. Yeah, throw out any tickers, guys, if you have anything of interest. We'll just continue down through some more of these alerts that I am looking at. Dollar CAD obviously giving us that bearish look still. Now, we did break through the structure, the demand down here. So that is a good sign. I wanted to see a break and then a retest. And that one supply had already gotten chewed through, or I should say bounced into. But that was before the demand had been broken. So I stayed out of that one because of that reason. But again, guys, there's a lot of zones I don't take because I'm not going to fool with support or resistance. Okay? If price just bounces. In other words, supply and demand for the way I look at it. A little further down, we've got a little bit of a supply going on here. So at this point, I might be interested in this. Maybe. Okay? It just kind of depends on the way the bounce looks. You got a red candle on this 1 hour candle here, the big one. But really, if you look at this thing, I would have to honestly technically say that would be the leg out candle, because we had our last green candle up before the leg out. It just wasn't that great. So I don't know about this one. I'm still kind of iffy on this particular zone area here. We can drop it down further and try to refine it a little better and see what picture gives us a better picture. And when we go down to the 30, now our red candle adjusts about midway to that zone. So I don't think I really like this look, because I have to honestly look at the candles that literally started coming out of the zone. And I just don't like this picture. So yes, I drew it up. Yes, it is an alert. But the reality of me taking that is it's kind of small. I mean, it is kind of a flip zone, but I just don't like the volume structure on that. So that's dollar CAD. Kiwi dollar. It's bouncing into that same 30-minute zone. Okay. This was another one that hit overnight while I was asleep. And did we have any overhead resistance here? I don't know if we did or not. Let me go double check the daily. Okay, so as far as daily, I would have to realistically draw up this daily candle here. So we have not touched that one. So had I been awake and had I wanted to be aggressive, obviously Kiwi is kind of the cousin of Australia. A lot of times when Aussie moves in one direction, Kiwi will tend to follow. It's not 100% correlated, but that's just another one I wouldn't have wanted to trade because of Australia's rate release, and then pressure there to follow. So this one I actually would have made a little more sense because we had not yet touched that overhead resistance. And it kind of became a sideways trend all on its own. So we did get that same 30-minute red candle on the layout. And at this point, for a brief moment, I was kind of looking at this as a sideways trend on the 30-minute time frame, because there's a very clear support level in this general area down here where the bottoms of these candles and wicks are. And then you could make the argument that you obviously had a resistance overhead. So if you're, I can guarantee you there were probably some sideways trend traders probably trading this area because of how big that volume bar was, again, from Friday's NFP result that we had. And that just so happened to go clear to the top of this range. So yes, this was definitely a supply. This was definitely a sideways trend traders, well, probably dream, to be honest with you. They like to see these setups where you're buying at the bottom of the range and selling at the top of the range. I'm more of a trend trader, guys. I don't like to do these sideways trends. Okay. I just don't like to do it. So, but just goes to show, getting another bounce off the zone, just like we did on Aussie dollar, Euro dollar, and pound dollar for that matter. I think pound dollar hit too. Or did it? No, this one did not hit yet. Okay. So anyway, that is the 4 pairs where the dollar is the quote currency. Pound dollar, yeah, nothing's changed. Still waiting on this 1 hour down here. Okay. This 1 hour, I do believe that one had the red candle as well. This was from Thursday, so the day before. Yeah, Thursday, the day before. So that's still going to be the one I'm watching, the 130, we'll call it 134 on that. Yes, I did draw up this demand zone here. This was obviously the same Friday NFP result. So I don't know. Same thing, guys. I just don't want to be buying here when I know that we've already bounced into a higher time frame supply. Higher time frame supplies tend to push price to another higher time frame demand and vice versa. It's a little high on the curve. I don't want to be aggressive unless we actually break through this structure here first. Break, close, and then we could possibly think about a buy right there. It's got to take out a structure. It's got to take out a supply zone for me to be interested in getting a little more aggressive. Okay. So that is going to round out the dollar-based pairs for, again, where the dollar's the quote currency. Gold, everybody's favorite gold. Really nice bullish signal still that we're getting over here on the Edge Finder, +8. Just basically at this point, I think I'm going to be waiting on the CPI result to see how it kind of shakes things out. The 2-hour zone of demand that I have been watching for a while, at this point, price is starting to run away from it pretty hard. So I don't know if I want to start chancing a downtrend, a temporary downtrend, to take a bounce from this 2-hour zone over here. I think I want to see a break of this overhead supply first, guys. Kind of a break, retest of this general area is going to be that equivalence of 400, the price level of 400 on GLD for Nick's new put and call wall tool. Okay, if we go over here, put and call walls, we look at that GLD, you can see the 400 level right here, right? Actually right here. Okay. So that was the call level. That was the put level. And we're currently in this area. So possibly that could work out for like a break retest. I just don't really like the demand area here, though. The volume wasn't really the sexiest on this particular area. Now, we still have time. It could rebase and then give us a strong move up. Maybe the CPI report, depending on how it shakes out tomorrow, could be the catalyst that says spike, close, and then retest. Right? That's an opportunity. That's an option. So, but yeah, the reality is for me today, there's nothing on gold until we really start to get the CPI tomorrow and then Thursday's PPI. Okay. I want to see what those two reports do and see if it has enough power to push price up pretty hard. Leave me some good solid volume on the CPI number tomorrow. in this general area, depending on where it shakes out in the next 24 hours, and then just kind of reevaluate it from there. Okay. But yeah, there's no denying the 400 is obviously a very solid number, a very psychological number for GLD. And when you kind of do the measurements, it just kind of equates to the same general area. So yeah, that's gold and silver. Pretty similar story. Hey, nothing really going over there either. The moment bouncing into supply, just like we are with gold. So gold and silver, maybe the CPI will give us a better concept or a better idea of it, whenever that hits. What we got over here for you guys? Pound Swiss, life. Okay. Yeah. Thumbnail designer. It's not stressful if you follow your plan. That's right, KMF. Got to follow a plan. Plan your trade and trade your plan, right? Yeah. Make it like a checklist, guys. I'm telling you. When you make this stuff like a checklist, it's just a hell of a lot simpler. I'm telling you. You got to get, if I can get my thing pushed over here, you got to write down one of these bad boys. Why is my stuff not working? Oh, that's why, because I'm way the hell down. You got to get you a checklist, guys. You got to get you a trade plan. Explicitly write down your order of operations, whatever rules you set for yourself. Okay. Fundamentals, sentiment, technicals, whatever your technical trend or your technical strategy is, explicitly write it down, and then explicitly write down the details. Okay, write down the specifics to your strategy. And if you want this thing to smack you upside the face every day, like I do, when I open my computer every morning, that window is the first window I see. It opens up like a half a dozen windows. My trade plan is always staring at me in the face because I don't want to break my rules, guys. I used to be terrible about breaking my rules, right? Not verifying volume, not making sure I have a strong gap away from a basing structure when it comes to zones I'm watching. Not making sure it broke a structure. Maybe I have 10 candles in a zone, right? Things like that. It's gotta smack you upside the face, at least for a while. That way you can't run away from your rules, because that's probably the number one reason traders lose. Risk management's up there, but not following a set of rules that you yourself set, guys, that's huge. Got to follow our rules. You can make just about any strategy work as long as you follow the rules. Okay? I don't know if that's a hot take or not, but think about it. A strategy was made for a reason. Somebody made money with it. Otherwise, it wouldn't be a strategy. Now, there's some silly ones out there. We often joke on here about the inverse fair value gap strategy and all that. I like to cut up about it on my podcast with people I interview. But anyway, yeah, not to get off too much of a tangent, but definitely write your stuff down. It will help a ton. Pound Swiss and then gold. Sorry, I'm getting off here. Pound Swiss or gold. Yeah, I just went through gold. Pound Swiss for you. As always, want to see what my daily looks like on the right. Well, this is as up gets, guys. So the trend is definitely looking pretty sexy. Pound Swiss over here is, I think that one went back to new. Oh, no, that's okay. Pound Swiss, number 9, +9. So trend is great. Edge Finder agrees with the top setups. Now we just got to find a discount. Well, what is this? All right, so now that we know the trend's up, I'm just going to go to a single chart view. What does this represent? What's that big, long E word this represents, guys? All that. What is all this nonsense? Is that not equilibrium? Is that not fair market value? Is that not where buyers and sellers agreed on price for, what is that, a few weeks? Yeah, so the July 13th. Now we're finally starting to break through that. A couple of higher highs lately. This is equilibrium. This is where traders get sucked in like a black hole and get stuck. Clearly. Now, this is a higher time frame. This is 4 hour. Well, I wouldn't say 4 hour, higher time frame, but it's higher than what a lot of people start off trading on. 5 minutes, 15 minutes. It's going to look different on a smaller time frame. But from what I see from this top view, that's just sideways nonsense. zones I buy from have got to be on the opposite side of this. So I currently still do have this zone clear down here. What is that, a 2 hour also? Yeah, I got a 2 hour zone down here. Now let's go look at this. This is giving us a pretty good discount. Okay, leg out. The gap could have been better. Wasn't the strongest gap, but it was a gap nevertheless. Expanded range candle. Broke this structure right here. The volume looked pretty good. Yellow candles. That's above average volume. That's institutional volume really getting the drive right there. So if we can get a retracement to that point for pound Swiss, then that might be a possible play. Now, that's a long ass ways away. I got to tell you, we're at 943 and that's at what, 780. So that's my math is terrible. 150 pips away. With a score this strong, +9, may not get down there. But if we do, if the good Lord helps, the trading gods or whoever, Ren, Stimpy, SpongeBob, whoever you pray to, if they bring price down to that level, hey, that's a pretty good discount. I would like that play. Really would. That's going to be the main one I'm looking at. Volume is a big reason why, because even on a 4 hour chart, we still have a yellow candle down here, which is above average volume. Okay. Otherwise, it's going to have to rebase and give me some higher highs and kind of create a new picture for me, right? Because you do have former resistance. You could say former resistance in here. If we get a newly created demand zone somewhere in here, then maybe this could be another option. So there's really always two sides. There's really always two options. It just depends on if we break structures or not. But now that we've broken this structure, this is basically your master pattern starting to work itself out. This is what? Contraction, right? Price is contracting in on itself. And then at some point you get that expansion up, expansion down, which is what I want to see in this example for that demand zone buy. So you get expansion up, expansion down, and then at some point the trend phase is inevitably going to show its lovely face. Okay. Now, sometimes it might take a few more expansion legs, right? Sometimes it might take even more than that. It's usually just a couple or so, right? We don't know. It starts turning into a sideways twister before it turns over on the land. At some point, one of those expansion legs is going to fall into a demand. Okay? At some point. Just never know. Never know when exactly. Couple demand opportunities right there. At some point, after we have this sideways contraction right here, right? Like we're seeing over here, liquidity sweep up, liquidity sweep down, another liquidity sweep up since we've just given a higher high. Same thing on the way down. At some point, I like to find those expansion legs drop into my demand zone so I can take the other side of it. Whether it's that one, whether it's that one, okay, it just depends. So that's what I'm kind of looking at for pound Swiss. That's master pattern, guys. Master pattern 101. If you guys want something to go search or investigate, go type in the master pattern on YouTube. Pretty good stuff, guys. It just basically shows you how the natural ebbs and flows of the market work. And to help you understand if you're buying under value or if you're buying over value, you're buying too expensive, right? Or vice versa for shorts. Okay. Exactly, Noel Comfort. Accumulation is a good thing to see. Okay. I've been watching this accumulation for a while thinking, okay, well, whenever the hell we decide to break out of that, that's where the eyeballs start going to the chart. So just want to see that accumulation up or accumulation, but then the expansion up, expansion down into our zone. So yeah, good stuff. It's boring. It can be boring, right? Who knows? This contraction could go further out. We don't know. We never know. Just depends on when the smart money says, all right, we're tired of the retail traders eating each other here, fighting or agreeing or whatever. We got to shake things up. So they tend to push price up or down first. You never know. Okay. They're going to suck in the longs and then they're going to smoke them fools to the downside. When price starts coming down here to take out this liquidity, well, now they're going to suck in the shorts and smoke them fools too. Because remember, you got sell orders here. I try to show you guys this from time to time. I know we get newer traders in here a lot. Okay, this is buy side liquidity from these short sellers that are continuing to try pushing price down. They're just leaving their stop losses up here, which are buy orders, right? Same thing down here. These buyers are trying their hardest to push price up, and they're leaving their shorts or their sell orders down here, their stop losses. So that's literally how it works. Now we've come up and sucked up this buy side liquidity. At some point, they're going to probably want to come down and take the short side out, right? And all I'm asking it to do is take out the short liquidity or the sell orders. They need sell orders to fill their buy orders, along with unfilled orders from the demand zone. And this is where I buy. Okay? That's it right there. That's the name of the game. All right, guys. So hope that makes sense. Yeah, like I said, I like to periodically show that example, especially for the newer cats out there. But yeah, that's pound Swiss. It's just got to do a little bit more work for me. How do I see if I'm out of accumulation time to place an entry? Well, I mean, yeah, you just basically look for the pattern. Again, at some point, you'll get the consolidation like what we're seeing here. Your contraction or accumulation or distribution. We don't really know because we don't know which way it's ultimately going to trend, right? But it just depends. I mean, are you in an uptrend like we are now? If so, I only care about the uptrend. And then again, at some point, it's gonna go sideways. Push up, take liquidity up. Push down, take liquidity down. It just depends on where my demand zone is, because that's ultimately what I trade is the demand zone. I don't trade any other way. That's where I time my bounce is when it comes down to demand. Okay. Sometimes this will just be a one leg up, one leg down, and then the trend. Sometimes it'll look like that sideways tornado I just showed you guys. It might be a few expansion legs up, a few expansion legs down. But ultimately, the demand zone, I don't care how many expansion legs it's going to be. I just want to see it drop into my zone. So, guys, I'm already out of time. My goodness. Get ready for tomorrow, guys. This is our last day of a little bit of a relaxing day, I guess you could say, before the shit hits the fan tomorrow with inflation. So we can see if we're actually going to get a trend or if the month of July was just a one-off. So take care out there. Have a wonderful day, and we'll run it back again tomorrow. Be safe.
Have you ever wondered how you could find more trades like this gold runner, or the S&P 500 breaking out to all-time highs, or this sell-off in dollar Swiss franc, which was a clean short opportunity? Well, all of these charts shared one major thing in common. They all had powerful macro fundamental catalysts driving price decisively in one direction, presenting a really strong trading opportunity. Hi, my name is Nick. I'm a 10-year trading veteran and the founder of A1 Trading, where we build market scanning software that help traders to track macro fundamentals, crowd sentiment, and the commitment of traders' data to best understand where institutions are moving their money. Our tools automate everything from studying jobs market data, inflation statistics, and economic growth metrics, bringing it all together into a scorecard or rubric that helps to spot better potential trading opportunities through our insights offered by the tools. So if you're looking to access our tools, stream viewers get extra discounts, and we're currently offering payment plans as an option for those who would like to split up the cost of our tools into a couple monthly payments. Alternatively, we also offer a free Edge Finder tutorial course, as well as fundamental macro course that can help you to learn the concepts behind the tools. Scan this QR code that you see on the screen right now to be connected with a real person from our support team. We have helped thousands of traders level up their trading through insights, dashboards, and automation. And we are passionate about this subject because having the right tools that hedge funds and proprietary firms keep locked in key is a powerful game changer for the average everyday retail trader. To explore our products, payment plans, and just to find out more and speak to a real person about this, scan the QR code that you see on your screen right now. Alternatively, the link can be found in the live stream chat or in the description of the live stream. On our website, you can find a collection of both free and premium trading tools that our team has put together to help traders take their trading to the next level. Well, you might be wondering, how can your tools help me? Well, whether you're a swing trader or a day trader, our tools are meant to help traders traders of all different levels of skill, time frame, and traders that trade Forex, commodities, indices, stocks, etc. At the core of it is automation, simplicity, and bringing it all into a one-stop shop for you to scan markets more efficiently and build a curated watch list of potential trade ideas. So regardless of what you trade, we hope that our website helps you in some way. And if you have any questions, feel free to contact us using the contact button in the top right or the live chat feature available on our website. We also offer free courses on fundamental and technical analysis on our website, as well as a range of free tools like, for example, our risk calculators that can help traders to level up their trading without paying a dime. Our goal is that our tools and site help you in some small way, and we wish you the very best in your trading journey. Thanks for listening.